Friends, good evening to all of you. I welcome you to this CPE meeting on Statutory Audits 2019-20 with a demonstration of detailed audit checklist by our former Central Council member, beloved Speaker CA Sripriya. Also joining us, CA Revati Raghunathan, Chairman of the CPE Committee as well as the IBC and Valuation Committee. And all the viewers, we welcome you. And as you know, the stat audits have been getting tougher and stringent going day by day, both for the assessees as well as the chartered accountants, including all the regulators across, be it SEBI, be it NSE, be it MCA, or be it even our own ICAI, where these UDNs have been made mandatory from 1st of July 2017, where you have to compulsorily, affix the UDN as and when you sign, including the ROC forms which we are signing electronically. Though there is no provision to put the UDN number, but the UDN number is kind of required to be generated and kept for our records. So for the timely completion, it is necessary that we use technology and the small tools available so that we don't miss out on important things, because a lot of reviews also which happen by ROC. So that is the reason we chose this important topic and see that our members benefit well early so that they're able to start the audits and incorporate all things which are being shared today. So before we let the speaker speak, I will request CA Revati Raghunathan ma'am to share her thoughts as we take things forward.
Yeah, you can hear me? Right. So good evening, friends. It's great that we are all able to join here today to listen to CA Sripriya to speaking on the statutory audit. In these difficult pandemic times, the emphasis is more on the audit procedures, because we have to calibrate the risks of any material misstatements which may occur at the assertion level and at the financial statement level. And I think that the fact that Sripriya has generously going to share with us the checklist which she has developed for the is going to help us all in avoiding all these material misstatements due to frauds or errors or omissions which will occur. And given the scenario where there is a huge expectations from auditors, the expectations have increased multifold now during this pandemic situation, because everyone is going to look and see how the auditors are going to present the financial statements. What are even though there are a lot of exemptions and deferrals which have been given by the various authorities, there is still going to be a lot of expectations from the auditors, and a lot of people, all the stakeholders are going to definitely depend on these audit reports which are going to be issued very, very soon by all the auditors. And it is just right that we have such a session which enables us to avoid these misrepresentations, take in the materiality concepts, see to it that all errors, omissions and frauds are avoided, and that our audit reports are given in line with the standards which have been issued by the Institute of Chartered Accountants. So I think that we are all going to benefit a lot through this presentation by CA Sripriya. So thank you. Welcome again.
Chairman, you are muted. You are muted.
Yeah, Abhishek, over to you to introduce the speaker formally.
Thank you. A very good afternoon to all the viewers. A very good afternoon to our dynamic chairman, CA Dungarchan Jain, Regional Council member, CA Revati Raghunathan, and the speaker today, CA Sripriya. I have the opportunity to introduce the speaker today, and I'll go ahead with it without further ado. CA Sripriya is a practicing chartered accountant, and she worked in Ford India Limited and PricewaterhouseCoopers before joining practice. She largely deals with clients in risk, IT consulting, corporate, foreign trade advisory, training in financial reporting, audit and compliance across many forums. She is also an insolvency professional. So regularly she addresses in insolvency matters. In fact, she is a council member for one term and then a central.
You should go off the video.
She is a reader, And sorry. Hello? Somebody?
No, there was a lag in your voice. You can continue, Abhishek. There is a lag in your voice, actually.
Sorry. She is also a reader, a traveler, a blogger, and has interest in Indian mythology and soft skills training. So this is only a brief profile.
Here's a very, very hearty good evening to all of you. I'm absolutely delighted to be, addressing this session here today. And it's very experiential in some sense. I'd like to speak about statutory audits for the year 2020. And I see about 300 participants here, and I'm actually overwhelmed. And I think one good thing that COVID has done to all of us is that it's carved out time for learning. I myself find that I'm either attending webinars or I'm speaking in one for almost 10 hours a week. And the kind of knowledge I've accumulated in the last 3 months on topics which I had never related to earlier has been phenomenal. And I think the current chairman, DC Jain, is doing a terrific job on this for a while now, and must compliment. And hello to my former colleague Revati as well. So without much ado, again, I'd like to start. So I have with me a very structured presentation. One is a PowerPoint where I will lead you on to the checklists, and two is the checklists themselves. So these checklists were actually developed for our own firm's internal purpose and are about 70% complete. But the remaining 30%, you'd have to actually look at it as well to refine it further for your kind of audits. So having said that, let me first walk you through the PowerPoint presentation that I have. This is largely for the younger members who might not have, done audits before, but I thought today I'd be addressing a fairly large spectrum of people. So I just thought I'll kind of, for the first 20 minutes, I'll walk you through these PowerPoint presentations because these reflect what are there in the checklists. And in all this, this is where a lot of these checklists bear their origins to where I did my articles, which was PW, where they had a structured methodology. And I have in some sense attempted to translate this methodology. And another very important thing is that the CARO 2020 has been deferred to CARO 2021. But currently there is no extension notification that's come to say that 2021 again is going to be deferred. So while not completely related to this program, it might be very relevant to understand that your client today needs to comply with CARO 2021 in terms of their stock audits, stock and book debts reporting, matching to the book stocks, etc. So I'd request DC, if you've not yet done a very elaborate program on CARO 2020, to do it for SIRC, because a lot of it is applicable for your client today. As you speak today, including things like liquidity, solvency, on which they'll need to be slightly better prepared. So what are we going to talk about today? Very briefly on the audit process, designing and implementing checklists, a sample checklist index. I've got about 30 checklists, a lot of which I hope will be useful to you. Another interesting thing about these checklists is you can add your CARO points also to it, in which case and then you can add your ICOFER points also. And these checklists are as relevant for internal audits as they are for statutory audits. And then we'll touch upon the key aspects of company audits 2020. I'm not going to go into great detail, but just to touch upon it. So again, what is a statutory audit? It's nothing but an expression of opinion on the financial statements. There ends the matter. What is a financial statement? It's what's well enshrined in the Companies Act, your P&L, your balance sheet, your cash flow, your SOC. Now, what happens in a financial statement? The financial statements are the responsibility of the management, which is again well enshrined in the Act. Then you have assertions. Assertions are what the management tells you that exists in the financial statement. You have assertions at a component level or a transaction and event level or a disclosure level. If I were to give you a very elementary example of assertion, let's assume I have a daughter to be married off or a son to be married off, to be very gender neutral. So I go and tell somebody, look, my son is 5'8" tall. He's studied so much. This is what he makes money. This is what we have, and this is his expectation, and this is how he's attitudinally. That's the assertion I make as a parent. And in this case, as the director operating the company, I make the management operating the company, I make these assertions. So if you were to extend this logic to an auditor, it's the bride's father. He comes and verifies whether these assertions are in order, and that's your audit process to state whether me as a parent have expressed a true and fair opinion on my child. So it's the same thing if you extend. Here is a management which comes and says, this is my fixed assets. This is 10 crore 2 lakhs. This 10 crore 2 lakhs exists as on the balance sheet date. The invoices for which these fixed assets were accounted are all held in the name of the company. So these are and then the assets are physically available, or we have verified it. These are our additions, and the additions actually came in and were put into use. These are the deletions. This is the depreciation. So the assertions basically go to talk about components of the financial statements. They talk about transactions and events that occurred during the period. And then the management also says, see, I'm giving you a block schedule, and that's nothing but how Schedule 3 wants me to represent my fixed assets in the balance sheet. Now, as an auditor, you want to ensure that the assertions are complied with, period. So in that sense, contrary to popular perception of what an audit should be, in fact, that's one of the biggest challenges we are facing today, is that you audit under a framework. There is an accounting standard framework, there's a standard on auditing framework. And that's something the market is really not able to appreciate, which is why, unfortunately, your audit procedures have to be slightly deeper in the current context. To add to it, you add your COVID-19 pressures, then it actually magnifies. So, so that's about assertions. Now, when you talk about assertions, it's also very important. Now, how do I satisfy my assertions? So let's go to the next slides. What are my assertions? My assertions are occurrence, completeness, accuracy, cutoff, classification, existence, rights and obligation, valuation and allocation. So in some sense, the way you view an audit today is very simple. In the x-axis, you have your components of the financial statements. In the y-axis, you have the assertion. What are the assertions each component of the financial statement should satisfy? On the z-axis, you have the audit procedures to be performed to satisfy those assertions. On the a-axis is the audit issues you come up with. And your b-axis is finally your opinion. Is it true and fair? Is it providing some comfort to me? That's the audit comfort that you get. So this is the whole gamut within which you do an audit, and it's very simply a X, Y, Z, A, B axis. Now, you have assertions. Now, as a parent of a daughter who's wanting to marry a boy, what do? I perform procedures. So what do? I do a check with somebody I know. I do inquiries. I do reviews. Similarly, as an auditor, you perform certain procedures. There are two ways of looking at these procedures, and all of these are from the standards on auditing. Strangely, for a profession that's focused on auditing, we take accounting standard compliance very seriously. But do we take standards on auditing compliance very seriously? I'd like to leave that question with you. Today, what matters is your compliance with your essays. So you predominantly have three types of procedures, which are your compliance procedures, your risk assessment procedures, and your substantive procedures. Compliance procedures are those procedures which are intended to ensure that internal controls are operating effectively. Substantive, so example, I do a purchase walkthrough. That's a compliance procedure. What's a substantive procedure? It's a test of transactions and balances. There is a fixed asset register, and then I have a balance and tally. Both these should tie in, and that's a substantive procedure. And right on top sits a risk assessment procedure. So these are the three kind of audit procedures which are mentioned in the standards on auditing, which are the procedures performed to obtain audit evidence. So this is one way of looking at your audit procedures. The second way of looking at your audit procedures is simply analytical review. See, today in an audit, you don't do a bottom-up approach. You don't go to a client and say, please give me a voucher. You don't. You do a top-down approach. And what's a top-down approach? You first look at the balance sheet, the P&L. You look at the components of the balance sheet. You look at the trial balance, and therein commence your audit. So today, if I find that there is a material change in fixed assets, then I need to audit fixed assets more. If there's a material change in inventories, a material change in consumption, I need to audit it more. So your analytical procedures can be across years which are performed or within the balance sheet itself. See, last year my debt service coverage ratio was this. This year my debt service coverage ratio is different. Last year this was my debt equity ratio. Last year selling expenses as a percentage of sales was so much. So these are analytical review procedures, and those procedures that you perform first. See, and in some sense, it's also very logical because you actually don't start an audit unless your client gives you a financial statement or at least a trial balance. That's your start point, because again, your audit reporting standards are very clear. The financial statements are the responsibility of the management of the entity. The second is observation. I observe inventories being counted. That's an observation. Enquiry. I find an invoice of a supplier. I don't find any Gmail, or I don't find a mail ID, I don't find a website, but I have a large value. So I call the supplier on that particular phone number. That's an enquiry that you do. The 143(1), which the Companies Act speaks about, those are enquiries. Transactions represented by mere book entries. Those are the enquiries. In fact, another thing I've been noticing of late is that if we take everything that's said in the Companies Act seriously, starting from your 143(1), we won't have as much problems as we have today, which is confronting the borrowers. The third procedure is inspection. So you inspect securities charged to a bank. You inspect investments held by the company in physical form. Confirmation procedures. In all of the audit procedures, the most superior procedure is the confirmation procedure. These are external confirmations where you go to somebody and say, please tell me what the account balance is. Is it correct? Is it wrong? It could be a vendor confirmation. It could be a debtor confirmation. It could be a bank confirmation. Again, there are standards of auditing on standards on auditing on confirmations itself. It's called external confirmations. Please comply. You have reperformance. Your client says, I'm on SAP. Now, when he's on SAP, what do? You tell, he says, okay, when I pass MeGo, which is a transaction code, my inventory gets updated. So you sit with your client and say, please pass MeGo, and she passes MeGo, and then you find that the stock actually has indeed increased because the GRN is taken. That's a reperformance test. You retest a particular control. Recomputation, very, very famous. Most of our clients maintain fixed assets registers in Excel. Now, the depreciation is calculated in Excel and it's passed into your system as an entry. You take the whole thing and you recompute the depreciation. That's a recomputation test. So these are the audit procedures. Now, in all this, it's very important to understand this, not in the presentation, but there's something called as inherent risk. See, and again, as Revati mentioned, why do you do an audit? You do an audit to confirm that the financial statements are true and fair and are free from material misstatements. Now, what's a material misstatement? Anything that materially is misstated. And so what is material? Material is anything that influences the decision of a user. Now, in that context, what's also very important is to understand these terms. Again, don't approach it as a science, approach it as an art. It's easier. Every component in the financial statement can suffer an infirmity. It suffers from a risk. It's called an inherent risk. Cash can get lost. It can get misstated. Fixed assets, there can be an issue. There is an inherent risk in everything in the financial statement to be misstated due to fraud and or error. That's inherent in a component. So you for a minute assume that this inherent risk is 1 or 100 is my inherent risk. Now, what does the management do to manage inherent risk? Inherent risks are managed through implementation of internal controls. Now, are controls sacrosanct? Well, they're not sacrosanct. So what happens? Because my control is not sacrosanct. See, I have a maker checker control, but somebody can happily just share the bank password. So a control can fail. So the risk of a control failing in some sense, or the control not being able to prevent an inherent risk from appearing, a wrong bank transaction going, is called as a control risk. But let's assume my company has great processes, great tone at the top. In all the screensavers, they write, please save password. Please don't share passwords. In all the coffee mugs, it says, passwords are yours and they're personal and intimate. Do not share them. So I find that right through the organization has password controls, but still one little person in the system can err. So what happens? I say, okay, my control is very high. So my control risk becomes only 10%. So the 100 that I gave to my inherent risk, if you multiply it by 10, because 90% my control will mitigate, the balance is only 10. Now this 10, as an auditor, you still have a risk that you might fail to detect a material misstatement, whether due to fraud or error. So you say, okay, I'm a very good audit firm and I'm following all my audit standards. I'm there. I know what it is. I'm implementing checklists. You will still have 10 is your audit risk. So the fact that a material misstatement can go undetected is a detection risk. So all these combine together to form an audit risk. Your audit risk can never become zero. That's the point. In any audit that you do, the chance of a material misstatement exists, which is why I keep telling in all the work that my office does, we do an internal audit report. I said, put all the points. Why? Because I myself may have discovered only 70% of the problem, not 100% of the problem. Now, given the context that you have a risk, how do you actually mitigate the risk? So today we're talking about an audit risk and an auditor's risk. An auditor's risk is being pulled up, and that's what good working papers do for you. So if you look at diligence and negligence, they are like two sides of a coin. The two sides being that one side is diligence and one side is negligence. Now, what's the thin rim? See, the coin can flip either way. Now, the thin rim that you have is your audit working papers and audit documents that you prepare. And how do you prepare audit documents? Through these audit working papers. Ultimately, why do you do? So at the end of the audit, I should be able to hold up a flag and say, look, I've got comfort. See, an audit as a process never ends, correct? You can, if you want to keep on auditing, you can keep on auditing a client. But at some point you stop. What's the point where you stop? That's the point when you've got audit comfort. You say, okay, I've looked at fixed assets, I'm happy, I want to move. That's called audit comfort. Now, what is most important about audit comfort is not getting to the point of comfort, but getting to the point of comfort in an efficient and effective manner. What is an efficient audit? I'm able to audit in the quickest possible time. While we might want to walk away from this problem, I think this fraternity has a huge issue of undercharging our clients. I firmly believe that a good fee drives good quality, which in turn drives good effort, and it in turn benefits the client. So, but today we are all constrained by fees. So I need to be able to do an efficient audit. Effective audit is different from an efficient audit. An effective audit is to get audit comfort, to get maximum audit comfort, which is where the standards on auditing play a huge role. So today it's not just that I go and do 100% vouching. I will do only 10% audit sampling. But in that 10%, I'd be able to very effectively accumulate content which is relevant for my audit. Now, in this audit, you'll come across things like, audit evidence. So for me, effective and efficient audit, I need to get the best possible evidence. See, today, imagine I have to go from here, let's say, to Delhi. Now, multiple routes I can figure out at multiple costs. Now, I'll figure out the smartest way of getting there to make sure that I don't stay in Delhi longer than I need to because my stay is expensive. It's an act of optimization. Now, that optimization is what you get through performing proper audit procedures and following a checklist. I can guarantee one thing for you. If you were going to spend X amount of time on audit this year, should you go through a checklist driven process, you will spend X by 2 time. 50% is something that a checklist driven audit guarantees for you. Not to mention that the risk that you're mitigating, and you're always on the right side of the coin, which is the diligence side, not the negligence side. These are fundamental principles we learned in CA Inter. Written evidence is better than verbal evidence. Audit evidence is persuasive rather than conclusive, which is why your audit working papers have to be documented, they have to be reviewed, they have to be signed off. I would like you to pay special attention to the NAFRA order that has been passed recently, which a lot of people would have seen. Trust me, I think this is the sign of things to come. This is the expectation on this profession today. If you go through the various paragraphs, well, they're all, I mean, one can debate either which way. But again, today, I do not want to spend time battling a system and figuring out whether it's right or wrong. When everything is within my potential to deliver a great job and stay safe, why should I bother about who's looking at me and who's not looking at me? Auditor obtained is better than client provided. So if you typically have a third-party confirmation, it's supreme evidence. You don't need anything else. External evidence is better than internal evidence. Logical. So there are various other things that are spoken about in the standards on auditing on evidence, but I think this is the crux of the issue. And the working papers say it all. See, it's in another context that this whole issue of auditors' negligence is sort of breaking out in a big way. See, in India, unfortunately, we don't have the definition of public interest entities. Now, obviously, listed company is a public interest entity. Now, I, as an auditor, should evolve my own definition of public interest. And some simple thumb rules that I find might be important or interesting for you is, obviously, if it's a listed company, public limited company, I have bank borrowings, I've taken fixed assets, fixed deposit, I have huge loans and advances. I have a big turnover. Where a failure will materially impact the public institution or the public, you can call it as a public interest entity. Incrementally, I will say if my firm has a large number of employees, I'm a public interest entity. So today, if you're auditing a husband and wife run company, primarily an architect firm, they both are doing a great job, good turnover, no bank loan, nothing. The way I audit them, and they are the two directors who are signing the financial statements, the way I audit them will be very different from the way I audit a client who's even got a 1 crore bank borrowing. See, again, I want to just emphasize this. The kind of issues that have come up today in the CARO 2021 is also the sign of things to come. For the first time in CARO, I see the following has happened. They have asked you to specifically comment on all forms of borrowings, which is both term loan and cash credit, including your stocking books reporting. On the application side of the balance sheet, they want you to comment on loans and advances and investments, fixed assets, inventory. So on the left side of my balance sheet, I have share capital. In fact, they want me to comment on revaluation reserve also today in the new CARO in much greater detail. Share capital has been, obviously intended to be covered elsewhere. But share capital is getting covered in your Companies Act, where shares have been insured for consideration other than cash. So they caught us there also. And if you look at the right side of the balance sheet, fixed assets, investments, inventories, loans and advances are all covered. Cash and bank is a logical fallout. Revenues and receivables, purchases and payables are your core operations. If you look at it between your main auditor's report, the inquiries, etc., I think somebody is not muted. Could I kindly request you to mute? There's some good music, which I'm sure sounds better, but can you just check who's not muting?
Selva, can you just ask mute everyone if possible from the back end?
Sure, I think it's gone really. No issues. So where was I? Yeah, I think this CARO makes a big difference. And I think currently, if you look at it, the expectation is to, keep a huge sort of watch on everything in your client's movement. And again, CARO 2021 makes a seminal change. It's no longer about solvency, which you were always interested as an auditor. Today, they want you to confirm liquidity. It's very, very relevant. And of course, we'll talk about it more later. So the entire landscape, the contour, the texture of how we seek to do an audit seems to have been transformed very, very dramatically in this whole process. So, and I bring you to the operative part of my presentation. I think I've sort of hard-sold enough, but Checklists help you to do an efficient audit, an effective audit, and let's face it, you have absolutely complex requirements. In fact, it's so complex that a lot of our stakeholders who are using our financial statements don't understand. In my recent experiences with bankers, they don't quite appreciate that a balance sheet, a financial statement means a balance sheet, a P&L, a cash flow, a main auditor's report, an ICOFR report, a CARO report, and notes on accounts. And unfortunately for us, we mention our qualification only in the audit report. I think there will be new things. Today we have a boilerplate system. This is how we just template. In fact, I wanted to suggest this, that, all reports which are qualified should be stamped on all pages as qualified, because it draws attention of the user. Much like credit ratings, which a lot of people just haven't understood at all. So there's an efficient audit, an effective audit, complex requirements, standardized work, delegate work. I think someone needs to mute. Selva, could you just check which participant has not muted?
Yeah, I will.
No issues. It's one of you.
Just one second. I will just take over the broadcast. Right, 1 second. Just 1 second.
On a lighter vein, you have a very tech-savvy chairman. I've seen DC at work. So
just give me a moment. Is it fine now?
Yeah.
Yeah, please continue.
Sure. Standardized work, it's framework driven. We need to manage by exception. So complex requirement, anything can actually make it materially misstated. Standardized work, today, one good thing is that it's framework driven. See, you don't have to apply too much thought, except for the last 10%, which is your intuition and how you want to modify the way you work. Checklists help you to manage by exception, primarily because you need to delegate work. You can't do everything. And you can develop your own internal practices of delegation. For example, cash and bank typically is done by a first-year student. So, but the BRS, you please keep a check. You ensure that the bank statements are obtained in original. And as a statutory auditor, you need to actually ensure that you cite, as the signing auditor, the actual original bank statements. And in some sense today, going with the checklist approach helps you to stay on the side of diligence, because if anything can go wrong, I think it will go wrong this year because of your COVID-19 risks. The inherent risks right across financial statements stand hugely magnified because of COVID-19. And today, you also need to take that very clear call. Whose interest are you trying to protect? I think it's your interest that you need to protect first. If something is wrong, it's wrong. It's not acceptable, it's not acceptable. If you have to qualify, please qualify. Doesn't matter what view you took last year, that's last year's problem. A lot of times when you do a bank audit, especially, the client will come and tell you, madam, you're seeing too much. The previous year, they never saw. Now, the same client will ask you, last year you didn't do that. Why are you doing it this year? You don't worry about that. If last year is a problem, we'll handle the problem. The only mistake is to continue a mistake. If your client does not have a fixed asset register, state so. Doesn't matter whether he had it last year or not. That's a different matter that you can handle with a little more tact and caution. So another important thing in these checklists is that it's called CAKE, Cumulative Audit Knowledge. So you kind of build. So you do this checklist for 1 year, and from the next year onwards, it sort of becomes a practice. See, the other interesting thing about this is, you might be doing only 5 statutory audits, but please remember you have 10 article trainees under you. Somewhere along the line, you have an obligation as a principal to impart the best possible knowledge, which is why I think even if it takes a day longer, and even if I am not reading an essay, I ask my people to read the essay, because I might be part of a generation that, I've sort of learned something and I'm continuing, and I look at it on a need to basis. But this is something that will be very interesting for your assistants, and that's the background of the checklist. Now, whether you should print it and use it is your call. Whether you want to keep it in Excel and convert it into a PDF, again, is your call. But if there is somebody very tech savvy who can convert this whole thing into a software program and do your checklists online, still a good call. So on some of these article assistants, I figured out if you give them anything, they are able to sort of the millennial generation is outstanding. And they add a lot of value to our own practices, especially in these areas. And my suggestion is to make use of them. So typically, as an auditor, what are the checklist categories I need to have? And please remember another thing is that it also helps in better client positioning. See, what is it that the big firms have that we don't, have? I've seen three categories of firms. Firms that audit 25% of the time and document 75% of the time. Firms that do 50-50. And a lot of firms, including sometimes my own practice, we work good 80% of the time. But we really, when it comes to the documenting and the signing off and things like that, we are a little lax. So I think it's important to be 50-50. Today, your documentation is as important as your work. Because another interesting thing is audit is not just books and records. It's books, records, information, and explanation. All four make an audit. So what are the key categories of checklists? Client acceptance, continuance, and audit planning. They are my primary checklists. Now, I'd like to, later on I'll come to it, but there's something called SQC1. Please read it. It's very, very important because it represents a firm's quality process. You have asset, liability, contingent liability, income and expense audit programs. These two checklists I have prepared and they're part of this structured format. Special purpose checklists, you have essays, which you can, they're quite well available throughout. A lot of people have done this. Standards on auditing checklist, auditing standards checklist. This year, a special matter of emphasis will be going concern. There's a standard on auditing called going concern. Please go through it. Another standard on auditing that is often not really looked at is called CLAR. Compliance with applicable laws and regulations. Please look at CLAR also this year. Schedule 3 checklist. See, Schedule 3 is more or less okay. You keep your Schedule 3 open from the Companies Act and then you quickly compare. Companies Act, checklists, GST related, TDS related, income tax related. You can have your checklists. So what are the features of these checklists that I'm going to show to you today is that it's pre-contract to completion. From the time you take over as an auditor, the annual engagement commencement, it's right up to completion. How do I finish and sign off? It's linked to assertions. If you recollect in the first part of my conversation, I spoke about the XYZAB matrix. This is completely in that same XYZAB matrix. 3, it's modular. It's modular both in an incremental as well as in a reducing sense. Now, if you feel you want to add 4 more points to it, since it's in Excel, you can add it. If you feel a particular component itself is not applicable for you, you can just say not applicable. If there are certain new components which are applicable to you, so for example, if your client has a merchant exporter scheme, something that I would have not covered in the logical framework, you can add that as a checklist and put it on. And every year, the fundamental framework is going to be the same. So you can just increment or decrement your checklists and maintain these for posterity. And I've also provided a small signature box at the bottom. So, you need to compulsorily have prepared by, reviewed by. I think it's very important. And in some sense, it's also the importance that you give to that financial statement. Now, before I go into the second part of my presentation, I'd like to just focus on something very small, but very, very significant. A lot of us end up auditing clients where there is no activity in the balance sheet. There will be one share capital. There will be either a bank loan or very unlikely to be a bank loan. There could be a loans and advances or just a share capital and a huge premium. And on the right side, there will only be a fixed assets, an investment and or loans and advances, which means the entity that you're auditing is primarily used only to route a transaction. Kindly, in fact, I've done some work on shell companies and I found that there is a public domain list of 16,000 shell companies, 16,500 shell companies, thankfully of which very little are in the state of Tamil Nadu. Most of them are, on the eastern side. So much so when I had done a presentation for EIRC, there were 1,600 participants in that webinar, which we operated for shell companies or for the EIRC. But please be very careful on whether the client that you're auditing itself is a dormant or a routing company. And this I will try and touch up very, very briefly in the various components that I'm handling. Now, I'm only going to describe the matters of emphasis. Qualifications, disqualifications as an auditor, extremely, extremely important. 144. Kindly read the NAFRA order. See, the NAFRA was a large entity, a company that crashed. In our case, it's smaller, but then the principles are the same. Are you doing restricted services? Please be very careful. Audit term and rotation, I'm sure all of us take care. Kindly remember that you're appointed for 5 years, a matter of tremendous professional strength. People can't hire and fire auditors at will. Engagement letter, institute is given a format. It's there in my checklist. If there is a retiring auditor, just imagine Caro speaks today about 2021 speaks about retiring auditor. It says, have issues raised by the previous auditor been handled properly? It's extremely, I am just sort of flummoxed at the kind of thought process that's gone into this new Caro. Internal audit and KMP applicability, very important. If your client needs to have an internal audit as per 138, then they should have an internal audit. There is no issue of not having an internal audit because it fortifies your own position. These are non-negotiables. If your client is supposed to appoint KMPs, has not appointed KMPs, you have a problem. I've noticed one more issue. In several cases, financial statements may have been signed by directors. We may even be getting a certificate that they are not disqualified under 164(2). But if you go to the MCA website, they have not filed returns in other companies where they are directors, and hence there is a 164(2) disqualification. So today the key aspect is don't take anything at face value. Please go into a little bit of detail. If your client has a Caro applicable, then Caro is applicable. ICAI applicability. I'm not emphasizing on this, but if your client has had a default in filing the annual return, then ICAI automatically becomes applicable, and please go through that notification unless it's changed in the recent times. Small company provisions are a relaxation. Private limited company exemptions, please be very clear on what exemptions there are. That much only your client can take. Of course, your 185, etc. stand amended as of today, but you have to be a little careful on how you handle it. Cash flow statements, where mandatory, where not mandatory, take it carefully. Share application money, please be very careful. If not refunded within a specified period of time, becomes a deposit. Depreciation, very important. Companies Act 2013 compliance. If your client still has not moved, doesn't matter you didn't do it last year, please move through the 13 Act at least this year and take the difference. Deferred taxation, extremely important. It is a requirement as per law because it shows you the correct effective tax rate. That's exactly what your deferred tax does. So please ensure that your client does this. Loans from directors and relatives to be treated properly. Loans from members. Loans to directors. Trade advances received. Essentially, the acceptance of deposit provision. Please be very, very careful this year because of the financial strain, there could be issues. Please ensure that you follow the relevant audit report format. Very important. Make sure you don't omit any paragraph or don't write beyond. The 700 formats are not meant to be changed. They are meant to be written. Fraud reporting. If there is a fraud, 143.12 reporting, be ruthless. If you have to report, please report. That's it. See, today the other challenge is, if there is a problem, no one's going to be rescuing us. So it's better to be safe than be sorry at a later date. Management, and I can tell you several stories of auditors who were not skeptical. They were good. They did not collude. They were honest. They maintained the highest levels of integrity, both professionally and personally. And yet these collapses happened for reasons that were just beyond them. They trusted a client. And today the mantra is trust but verify. Please be very clear about it. Management representation letter. Please do obtain a management representation letter. Again, there is an institute recommended format. Going concern reporting, very important. Check if your client is associated in any IBC process and something has got filed. You would know about it. SAAS Schedule 3 compliances. Of course, the Companies Amendment Act, the latest one, whatever it is, needs to be followed. We come to the second part of my presentation now. So all this was suffice to say that do a great job. And it's not just enough if you do a great job, you need to actually document that great job even greater than what you're doing. And just hope very humbly that this will be of some help to you. So this is my little checklist I had made. Acceptance and continuance related.
Sripriya, we are not able to see anything on the screen.
Okay, 1 minute. Only
Yeah.
now?
Only now, yeah.
Super.
Can you just Yeah, now it's fine. Yes.
Okay. I think there was a lull.
Okay.
So you have acceptance and continuance related. You have engagement documentation. You have understanding the client business risks and risk assessment. You have an audit planning memorandum, component-wise audit program for assets, share capital and liabilities, expenses. Now, why have I not put revenues? Because I add revenue along with my receivable. It's slightly inseparable. You have expenses. You have a small TDS checklist, and I'm sure all of you would be much very good at this. If at all you need a GST checklist. And another problem we have in India is the tax audit happens after the statutory audit. It should be the other way around, actually. Similarly, the GST audit happens much later than the statutory audit. These are limitations. So ideally, finish off the GST audit and then do the status, what is recommended. Key checklists, templates I have not added, but this is what I have to present before you today. So what's an acceptance checklist? See, today you need to KYC. You have to know your client. And each auditor has our own acceptance of risks levels. I might say today, no, I'm not interested if it's too risky. I would calibrate so much of my risk. Some of us might be more open to a larger value of risks as well. So what's very relevant is that, do I need to follow all this? Yes, you need to follow. Do I need to write stories in these checklists? No, you don't. You just need to cover each of these, because all this will impact your audit strategy and your audit program. So there's nothing in it which is not related to your work. So tone at the top. So before you engage with a client, are there any issues that we come across with reference to the integrity of the management? Any big, statutory violations which have been reported in the media, etc. Aggressively low levels of fees which your client is expecting. Industry trends. Significant issues with the client. Is your client in a regulated industry? Is your client a subcontractor in a place like Trichy, which was very BHEL dependent? Then the way you audit that client would be very different, because there are pressures all the time. Have you seen the past financials? So if it's a new client, please download the entire NCA data and have a look at it before you accept. Auditor independence assessment, which is your own assessment. All the independence criteria you need to satisfy. Conflict of interest. Sometimes a client might say, if you're doing that shipping company, you should not audit me. So ensure that you maintain those conflicts. Of course, the larger firms have Chinese walls. Honestly, it's between your client and you. So if your client is fine with it, do it. If it's not, please disclose and not do it. Past auditor communication, becoming compulsory in CARO 2021, but it's a very good practice. See, if somebody has resigned or somebody has been asked to leave, I think my antennae would go up. I will say, why is he not doing it? Why am I being asked to do this today? History of personal professional changes, team competence. Today, how the company operates is also very important. See, I'll tell you why this is important. If there is no proper finance office, I can still be the auditor, but the amount of work I will have to do to prepare my schedules for this audit, to figure out the numbers, will be a lot more difficult. This assessment, while it's statute, sort of mandated by your SQC1 acceptance formalities, etc., it's very useful for you to determine your fee level. So if each one of us in this audience decides to do this process objectively, all of us will feel like charging more, and it could actually result in a manifold increase, which this profession rightly requires at this point in time. Continuance checklist, more or less the same thing as the acceptance checklist. But you have the benefit of your previous year work. So if you have not yet appointed, you can't ask for his internal audit reports. Some clients may not give, but you can have in your continuance checklist, there will be previous financials, internal audit reports, previous audit reports, unresolved audit issues that are material and significant, etc. Then once you are appointed or going to be appointed, the client will ask you to give a consent certificate. And this consent is required under section 139. And this is a standard format certificate. It says it's as per the term. It's within the limits. And again, limits, please remember, I think the institute's limits of 30 still stand. The Companies Act initially started with 20. And I think personally to me, it was a huge setback in terms of how the law wanted to operate and how it operated. The law first said you can't audit more than 20 companies. Then by a notification, it said, if your paid up share capital in a private limited company is less than 100 crores, then it's not counted for the limit. Which I thought was a bit of a joke because you don't really come across private limited companies, that too not net worth. Paid up share capital being less than 100 crores it was a virtual giveaway, which means the Companies Act had no limits. But the CA Act says 30 audits, which is still to be maintained. No proceedings or whether there are any disciplinary proceedings. And this is the certificate that you give. The next thing that you do is to do an engagement letter. Is it mandatory? It's doubly, triply, quadruply mandatory. Can I make changes to this? Please don't. Please get an engagement letter signed. Just 1 minute. I'm in a webinar. I'll call you back. I will call you back. I'm in a webinar. Yeah, sorry. So there is an engagement letter format. So in this engagement letter format, Institute prescribes 2 formats. One where ICOFER is applicable, one where it is not applicable. If you click on these links, it would open it. And these form a part of SA 210. Just review these and there you go. Can't get more easier than this. It actually clearly defines. This is almost like a contract. It says what is my role, what is my responsibility as an auditor, what is the client role, what is his responsibility, what is my fee, both of us sign and accept. What is the scope of work to be performed? It's so clear in terms of being a contract with your client. NOC, if there's a requirement, please obtain an NOC from the previous auditor. And these are the preliminary stuff that you do. So, yeah. So the first part that you do is to understand your client's business. So what do you do in understanding the client's business? Basic data, ownership and governance, industry dynamics, accounting system and internal controls, key laws and regulations that impact the client's business. Why is this important? Because I need to know who I should ask for data, who will sign off on the data, who's going to help me with the audit process. Again, your client might have one accountant with whom you're coordinating. Nevertheless, still go through this process. What's the basic data? Where is my registered office? What is the nature of my business? How many branches? How many factories? How many converter locations? How many warehouses? What are the key products and services dealt? Do I have any sole selling arrangements? Do I have any sole buying arrangements? Important things that you need to register at an entity level to appreciate the risk. Today, if you have a factory, then how are you going to audit during COVID? It helps you to define your strategy also. How am I going to receive data? Now, previously, I used to do it in 20 days because somebody would go to the factory and do it in 2 days. Today, the person will be sitting here waiting for data to flow. It's going to take you 3 times as much time, which means are you going to recalibrate your fee? In fact, I did read a newspaper report very recently that said all the large firms are proposing significant fee increases. Should we also not consider it? Please keep it in your mind. And in a lot of circumstances, I also think we don't ask. So I think it's important to be proud of our work and actually make requests. Now, whether the client approves or not is a second issue, but then there is work that justifies an added fee this year. Ownership and governance, who are my shareholders, who are my KMPs, directors, independent directors, board committees, list of all related parties. See, look at a typical COVID pressure. I can always book a sales to a related party and finish it off. I'll show a top line up, show something, I can show a profit, and you could end up signing a wrong balance sheet. So be careful. Industry dynamics in terms of seasonality. So if you're auditing a notebook company, very simple. March, April, May will be maximum sales because June is my school starting. So no point trying to do yearly trend of sales in such a company. It just will not fly. Key customers, key competitors, key suppliers, etc. Accounting system and internal controls. Does my client have an SOP? Do I know who will authorize a purchase invoice? Can anybody raise an invoice? What is my delegation of powers? What is my IT environment in the entity? What are my financial reporting protocols? Do I have MIS reporting? Is my MIS reporting tallied to financial reporting? These are important questions that you need to ask. Now, let's assume you have a client which has nothing. You still go ahead and write nothing. And at the end of this sheet, you can say that since my accounting system, internal controls, etc., are not very robust, I'm doing a 70% vouching of all material transactions. Finished. That's your audit strategy. If you have good internal controls, you do less vouching. If you have low internal controls, you do a lot more transaction audit than you have to otherwise expected to do. And there is no via media from this. This is your thumb rule. So today, when you accept a client, you might even want to say, look, unless the client has some basic internal controls, I might not want to, engage too much. Risk of material misstatement. But today, this is again an extremely important checklist. So the way the entire standards on auditing want you to do the audit is that first is it's a bird's eye view. I assess the entity. I assess the tone at the top. So read these fraud reports and stuff like that. You'll come across one thing. Today, the biggest threat is management overrides of controls. It's a very unique term. Everything will be fine and there'll be one JV that gets passed. There was a company which a couple of years back started a warehouse and sent everything to that warehouse and called it as a sale. It was a management override. So management overrides of controls become very important. So you have general and group related. What is the management view? How ethical is their business behavior? Difficult to fathom, not easy, but some amount of assessment. See, tomorrow, nobody can ask you, why didn't you do this? Significant RPTs, related party transactions, capital structure characterized by complex cross holdings, adverse media reports. What is this? I'm going to just take my client name, Google, put the client name. If it is not there, it is not there. Well and good, finished. This procedure is over. Dynamic or volatile industry conditions. For all this, you're going to put one bracket that says, because of COVID-19, my client is significantly affected. Personnel related, lots of people quitting the company. Forget the COVID year. But every year, my MD is changing. 100% there is a problem. There's already something that's gone wrong, in my opinion. So please be careful. So these are what you call as red flag indicators. I had the opportunity of, doing some work on red flags for a different context. I'll send it to Mr. Jain, and it's already available in the public domain, but it might be useful for a statutory audit also. Internal controls and internal audit. All my internal controls, are they there? Significant issues in audit reports, management assessment of internal controls, whistleblowing, fraud reporting, etc. Significant financial statement transactions. What are my significant transactions? See, today you might ask me a question. Say, madam, I'm only auditing a small company. Run through this checklist, that's all. If I'm doing this checklist for 100 crore company, I will do it differently from how I do it for a 3 crore company. But even for a 3 crore company, please do this. A lot of it may not be applicable. For example, significant forex exposures. You will say the entity undertakes no foreign exchange transactions. Isn't that a very comfortable statement? That's it. So how do I document this checklist? There are no imports or exports in the entity. Finished. Finish this question. Done. Significant? No. So how do I document this? 1 JV for sales last year at rupees 2 crores. Why is this important? This is important because it reflects a tendency of your client. So significant management and accounting estimates. You might have 1, 2, 3 warranty provisions. There could be similarly, so this could be an example where a client has a project litigation. Somebody is claiming 10 crores from them. So the moment you walk through this checklist, you're at least asking your client the question. Because audit is as much about inquiry as it is about information and explanation as it is about books and records. A lot of this you will not get in your books and records. You can at best look at your legal fee, and you will, here when you do this, you ask a pointed question and get a pointed answer. And this is evidence in a disciplinary proceeding tomorrow. This document is an evidence in a court of law tomorrow. You need to build this evidence. So, for example, your client might have no business continuity or disaster recovery planning. Nothing. Our friend is not even keeping a tally backup data. At least you discovered this today. Please ask him to take the tally backup. And today, as an auditor, you please take one tally backup. Because if his gets destroyed also, whatever you have signed for, you have it, right? So it also helps you to make some timely audit decisions. So for example, if I have a project litigation for 10 crores and I'm not taking a provision, I will ask for a legal opinion for not taking the provision. Great, done. So these are factors which can inherently enhance misstatement. Then you come up to an audit planning memorandum. Now, first of all, what is an audit planning memorandum? It tells me what all should I focus on, how many days should I focus on, who should do it. Because quite logically, your best resource should be doing inventory. The partner should be looking all my balance sheet, ITGC. You'll have your tech savvy person doing your IT general controls. This is very important. So understanding key components, one simple method I have given is to just put down your numbers. What is the variance? Now you can have one more. You can have your key ratios also done, which unfortunately didn't strike me, but I can put out some key ratios also here. And based on this, for every component of the balance sheet, you give the risk and materiality. So this year, my fixed assets was high and high. Why? Because I had fixed assets in the previous year, 2018-19, for 10 crores. And this year, it has become 42 crores. My variance is 42 minus 10. So my fixed assets have gone up by 320%. Okay, so so these are the this is the way you approach, and then you say my risk and materiality is high. Investments always high. You know why? Because your client could go and put some money in some dormant company and it'll be just sitting there and sleeping, and that dormant company could have siphoned something. So be very careful. Today, more than operating elements in a balance sheet, it's extremely important to take charge of dormant elements, dormant assets. So audit plan, you will be able to figure out. So engagement partner, how many days are you going to spend the time? Similarly, in an audit planning memorandum, you'll have materiality threshold. What is materiality threshold? Am I going to look at, I might just take a call and say, as an auditor, I will look only at bank payments above 3 lakhs. I don't want to touch anything beyond that. It's still your call. But you have to be a little careful, because if it's on a small profit, your company has made a 1.02 lakh profit, you have to be very careful with materiality. Because 2 transactions and it can move into a loss. So with due cognizance of this key issues, you might want to make a change here. Right? So So this is what you typically carry out in an APM. Engagement scope. What all are you going to do? See, this is another good one. Now, when you're doing tax audit, GST audit, transfer pricing, everything for the same client, you can club it into instead of doing 6 times one audit, right? So it helps you to manage your time better. Now, here you can have another thing. You can have ICOFR, yes or no, CARO. See, today it's actually 3 audits. CARO is a separate audit, statutory is a separate audit, ICOFR is a separate audit. So they all come from 3 different points and then they converge on your financial statements. It's a lot of work. The next thing is we go to fixed assets. So from now on, we start with the components. Now, let me just take one step back. Until SOX happened in the US, the Sarbanes-Oxley, audits were largely financial statements focused. You have an input, you have a process, and you have an output. My statutory audits were largely output focused. I had to say whether my financial statements were true and fair. Now, but when SOX came in, they said, no, I'm not just interested in that true and fair. Tell me whether the internal controls, the process itself is robust. And that's what came in as ICOFR in your 2013 Act. So at some level, when you're doing a statutory audit, you're as much covering your ICOFR, which is the process, as well as your financial statement assertions, which are your end result. So in that sense, if you look at it, I have again broken this up into a simple idea. What do you start with? You start with financial statement component. Again, for the sake of convenience, I apply this when I'm doing an audit. We do a balance sheet audit. So my bunch number A is called fixed assets. B is inventories. B is investment. C is inventory. D is revenues and receivables. E is cash and bank. F is loans and advances. These are my bunches. Each one is a paper bunch. AA is share capital. BB reserves. CC secured loans. DD unsecured loans. EE is current liabilities. For all that you want, you can call this as Roman number 1 to 15 also. Not a problem. You have a separate one for contingent liabilities. FF. GG could be CARO. CARO. HH could be your ICOFR, etc. So you need to have some working paper model. And if you're maintaining it in soft copy, so there'll be a client, there will be a year within a client. And within that year, you will have these each component taken separately. So first among them is my fixed assets. Now this is like an onion. So we touch the outermost shell of the onion. Now we first peel the first layer of the onion. So if you any component of a financial statement that you look at, what do you start with? So there are certain fit outs, correct? It's like metadata. So you take fixed assets. You imagine what are all the processes in the fixed asset. First is my reconciliation with my general ledger. That is there for every component. Reconciliation with general ledger and opening balance is there with every component. Additions during the year. Deletions during the year. Depreciation. Fixed asset register maintenance becomes very important because CARO tells you that you must have proper processes for records, etc. Then you have physical verification, which again CARO says management is verified, they have a plan of verification, etc. Impairment is important because if an asset is there and it's not sitting at the right value, you have an impairment. So, and you have asset movements. It's moved from one factory to another. How do I know? Right? So these are my building blocks of a fixed asset register. And in each building block, I will do some audit procedures. So overall procedures, additions, deletions. I left this personal and revenue expense. Very important because this fixed assets and related expenses are one part where a lot of this personal revenue can get mixed. And your repairs and maintenance. Similarly, capitalization, which comes as part of addition. physical verification, idle unutilized assets, control over asset movements, depreciation, fixed asset register, revaluation. See, when I was talking, I missed this out. Again, Caro speaks about revaluation. Title and insurance, very important. Special categories of assets. Suppose I've bought assets under EPCG. I need to cognize for those. If my export obligation has to be disclosed as a contingent liability, if my export obligation is not met, I have a penalty. All of the related disclosures, I need to bring it in together. Deferred taxation. Your depreciation creates a deferred tax impact. So that you remember, when you're doing your deferred tax working, you do it. But here you just say, yes, will be handled during deferred taxation. And review of CWIP. Another very interesting thing. In all these dormant companies, there'll be a lot of money sitting as CWIP. How long will it sit as CWIP? Let's say my company is in the CWIP is sitting in Rajasthan. Please get somebody locally in Rajasthan to go and have a look at it and say whether the CWIP exists or not. Because as an auditor, remember you're signing off for an assertion of existence. So in terms of the XYZ axis, X-axis was the component, Y-axis was the various procedures that had to be performed. Sorry, Y-axis was the assertions, Z-axis was the various procedures that were to be performed. A-axis is your working paper or your audit comfort, and B-axis is your exceptions or your audit reporting, if necessary. I had a while ago prepared two registers under straight line as well as WDV. Both these are self-explanatory. You can use this to do your Companies Act 2013, recreating a register if your client does not have it. More importantly, you can use this for reperformance testing. If your client has capitalized something today and you put that capitalization value and fill up the correct numbers, it will give you how much should be the final net block and final depreciation for this year. So your apprentice can actually use this to calculate whether it is correctly done. Of course, I'm sure you're completely capable of doing the same thing in a vertical Excel. This was done for a specific purpose and hence would need to be treated as such. Similarly, I've done another asset register for WDV processes. So this is the same thing that I have done for WDV. And under WDV, of course, it's slightly more complex working, but it will help you either which case to do a reperformance test. Reperformance tests are also usually performed for interest on cash credit, interest on loans and advances, etc., when the computation happens. Now we come to the second part, which is investments. Investments, basically, the disclosure is very important. I have seen a significant number of balance sheets, not in our geographical area, where the name of the investee companies itself are not disclosed. Not allowed. In Schedule 3, you're supposed to say quoted, unquoted, and give the names of the various investments that are being held. So again, when you're talking of investments, what are the major items, overall procedures? See, and again, just to talk about fixed assets for one more minute, all your additions, etc., you will do compliance procedures. This reconciliation of fixed asset register to tally total is a substantive procedure. It's a test of transaction or a balance. Please give me a minute. If you don't mind, can we take this break here at the end of fixed assets? I will just need to plug into my charger for the laptop. So instead of 6:30, we break now at 6:20. Can we reconvene at 6:30, please?
It is 6:21. Can we rejoin at 6:25?
Oh, 5 minutes. Yeah,
6:36.
Yeah, sure. Thank you very much.
So I'll just take over the screen for a moment and then give you back once you are coming.
Sure. DC, I'm
Sripriya, you have to unmute yourself and speak.
Yeah, I have unmuted.
Yeah, I'll just give you the presenter rights. For members' benefit, we have shared the links of today's material as well as the feedback and the past programs of SIRC link. You can access those all times so that I don't have to send it individually to you. And we'll be also sending you the email with these links, the video recording links as well as the materials. So you don't have to worry and asking for it. We'll be sending the email also later.
Thank you so much, DCN. It's actually very nice to see a chairman sitting through a presentation.
I think your video is not visible, maybe due to bandwidth issues.
No, I have not started it.
Started. Okay. Sure. So you can share the screen and continue.
Is it visible now?
Yes.
So this is on fixed assets. Now, investments. Similarly, when you go to investments, I had mentioned this to you, I'd be very skeptical about anybody paying my client money and not wanting it back. Similarly, I would be very skeptical about my client paying somebody money, whether as an investment or a loans and advance, and not tracking it. These two are very, very important to ensure, because I think somewhere along the line, until 2013 Companies Act came, there were no restrictions on layers of companies. A lot of companies got floated, and a lot of these companies were used to layer, launder, move money, etc. Now, another very interesting thing which I must bring to your notice is, I read somewhere that out of 18 lakh companies in India, 6 lakh companies have got struck off. Now, the only way you'll find out whether your client is struck off or not is to look at the NCA data for these companies. So please do. Because if your company has got struck off, then it is not at all a legal entity for the purpose of audit, signing, etc. So two key safeguards that you will need to ensure are, number one, your directors signing the financial statements. See, because if your directors who are signing the financial statements are not eligible to do so, you have a problem. Because the Companies Act says that it has to be signed by 2 directors, and where there's a chairman, the chairman also should sign. And then one more director, and then the statutory, then the auditor, then the company secretary also has to sign, CFO, if there is a KMP. Please, the average chance is today one of the 3 companies which is your client is a strike-off company. So please exercise safeguards. Now, this struck-off company acquires one more significance. If your client has put money in a company and that company has struck off, then again you have an impairment issue. So the bottom line is, you need to identify the directors of your company. Be very careful about it, because there are again a humongous amount of namesake directors. Please be a little careful on all this. In investments, I have overall procedures. I have additions and disposals, accretions in terms of dividend, bonus share, rights issues, etc. Schedule 3 disclosure requirements, valuation of investments, income from investments to be properly accounted. But the most important safeguard is the entity or person in which I have given money to as an investment, is the entity or the person confirming the said investment, is the investment good and recoverable, is the entity in which I have put in the money not struck off, is the director of the entity in which I have put the money not subject to disqualification, will also become important. Now, again, a lot of times you find that there is no paperwork for this investment. Why? After all, my client has put 10 crores as another entity. There should be a share purchase agreement. It might have happened 3 years back. My request is, it's a piece of paper that gives your client the legal right to enforce an obligation on the other party. Whether it is, you call it as a cumulative preference share or equity or by whatever name you want to call it, you have to be very clear that there has to be an agreement. Again, I want to draw your attention to CARO 2021. See how much has changed. Previously, they were talking about only loans, advances, etc. in the context of related parties. Now it talks about all loans and advances. A lot of things are changing today, which is why I want the auditor today. I feel we should be far more alert. Now, if your client will say, no, that share purchase agreement is all very old. Tell him, boss, I want to see a copy. He will immediately say, you didn't ask for it last year. I said, forget last year. I want it for my records this year. Please, is it there or is it not there? Now, I've seen a lot of cases where there is no agreement between two companies. Could be a related party also. No interest is charged. And then there is a nice little line that says no interest is charged. Other than this, nothing is prejudicial. Don't you think that the non-existence of a loan agreement itself is prejudicial? Tomorrow, if I want to legally recover this amount, where is my recourse where I don't have an agreement? So that's very important. Please just go one level deeper for this year. And another interesting thing is when you read an agreement on whatever, your vendor, your purchaser, whatever, supplier, customer, as an auditor, should I read all of it? No, I will only read some basics. Who are the parties to the agreement? What is my role? My client's role, client's responsibility. What is the other counterparty's role? What is the counterparty's responsibility? What is the period of the agreement? Is it continuing to be valid? What is the consideration? What are the liabilities? Then you are completely, and where is the point of dispute and where is my arbitration or jurisdiction of it? These are the essentials that you look for in any agreement, whether it's a loans and advance agreement or an investment agreement, any form. Then we come to inventories. Again, if you're looking at breaking down inventories. So one more little thing I want to add. See, when I do an audit today, it's an integrated amalgam of internal controls plus stat audit, compliance. Everything is like one big boiler. You just put everything in, just let it kind of steam out. The following terms are very important. So I told you one ABCD, XY ABC matrix, right? I'll tell you another matrix. Financial statement component, process or sub-process, which is what it is. These are my processes, overall procedure. If I take inventory, overall procedure, control over receipts, control over issues, inventory custody, inventory ledger review, write-offs and adjustment, inventory verification, inventory valuation, and provisions for inventory. Next year, you will add one more audit procedure where you will say recon of bank reporting to financial accounts. Because the new CARO says whatever returns are filed to the bank, the statutory auditor in the CARO has to say that it is reconciled to the books, which is why I told you, please prepare for CARO 2021 now itself. If your client is submitting any statement to the bank, ask him to first get your sign off and make sure it's there in the books. And I'll also tell you why it happened. I think a lot of the stock and book test reporting was all generally done. You know, in some cases, the client will pass on purchase entry before the day the bank auditor comes. And then the next day, if he reverses, nobody knows about it. So it's important. So now the component, the process, sub-process, we finished. There are two interesting things. So when you do an audit, you also look at control design. So again, I'll give you a very primary, primitive example. I have a daughter who's in class 10. She's not great at maths. So that's my risk. So I actually put her in a maths class. That's my control design. So the control design is I have a math class in place. Now, whether she goes to the maths class every day or not is called as operating effectiveness. So similarly, you have inventory, you have processes and sub-processes and risks associated. The fourth block is you forget inventory. There are processes and sub-processes. There are risks. There are control designs. And there is operating effectiveness. So everything in terms of a compliance procedure, this is how you view it. So we finished A, B, C inventory. Similarly, you have revenues and receivables. So in revenues and receivables, what are my components? My overall procedures, obviously. My sales register should tally to my general ledger. My receivables balance should tally to my tally total of receivables. My provision for bad debt schedule should tally with my tally total of provision for bad debts. My previous year opening balance of debtor party-wise should tally. So these are important processes. Control over masters, master data, order processing, invoicing, dispatch and sales booking, collection accounting, debit and credit notes. See, these are some of these important controls you may want to check. I'm not an expert on this. But today, let's assume your client has an accounting system where there is an aged receivable. The receivable is 200 days old. For that receivable balance, if your client passes a credit note dated today, and tomorrow he passes, and same today if he passes a debit note, will my aging change? Will the system start taking the date of my debit note? Say I had a receivable of 100 rupees, minus 100 through a credit note today morning. Immediately after that credit note, I put a debit note plus 100. So my receivable balance is still 100, but is an evergreening possible. Please look at it, think about it. I don't know whether Tally will consider this aging, but some of these basic things, why? Because you are only reporting. See, in your Schedule 3 reporting, you are certifying that report of greater than 180, less than 180. Please be careful. These are small safeguards. Similarly, I think because of this COVID, your revenues may have had significant pressures. But COVID really started only on 20th March. So that's something you'll need to examine. So when you do sales, again, a lot of this is first principles. You need to clearly understand when a sale gets recognized. I think that's extremely important. Is my sale recognized when goods are handed over to an independent transporter? Or is my sale complete when my delivery happens to my client premises? These small things, you just take 1 or 2 contracts, have a look at it. It'll help you to actually understand whether you have a revenue booking issue or not. See, what can happen in revenue? It can either be overstated or understated. Overstated, you can pass a complete fictitious sale itself. The other thing that can happen in your revenue is goods invoiced but not dispatched, in which case the sale is not complete. See, one of the good things about the Indian context of audit is only one thing. Your filing date is only September. So you logically have time at least till August to perform 2 very powerful tests. It's called the test of subsequent realization. I booked an invoice in March. By August, I should have received payment. If your confirmation procedures and tests of subsequent realizations are satisfied, then your debtor was good and recoverable as on the balance sheet date. Again, what's also very important when you do revenue is your client should not do FIFO adjustment. The client, the customer will keep on paying and will keep on adjusting FIFO. No, then you can have a material misstatement issue. So which is why when you get a balance confirmation, you must confirm the correct closing balance and the composition of receivables. The next component we come to is cash in bank. Controls over receipts, controls over payments, cash custody, cash insurance, cash verification, Schedule 3 presentation and disclosure. So these are the basic cash fundamentals. In fact, for programs such as cash and bank, you can virtually do a copy paste and do an internal audit. It's that simple. Bank balances. So control over receipts, control over payments, bank confirmations, very, very important. Bank reconciliation statements, again, very important. Now, today, don't look at BRS just as a document. See, if you want to have proper internal controls, your client should actually prepare and sign off a BRS also. A lot of people don't sign off. Please ask him to sign the BRS. It's important. If yours is a large client, tell them we need to see a signed off BRS. A. Because that's management's responsibility. As an auditor, this is your responsibility. Now, again, in this day and age, can I have a check deposited, not credited? Very difficult. Your turnaround times are quite fast. Similarly, can I have a check issued, not presented? It's not possible. No? A check issued not presented means it is in somebody's drawer and somebody is asking, let's say, $1,000 for every check. In fact, the SOX controls, etc., say that the moment a check is cut or written or an instrument is done, it needs to go directly to the vendor and should not come to any part of my accounting, finance, or user functions. The small things, but could be interesting. New bank accounts, dormant bank accounts, clients with a lot of bank accounts. Check these. Schedule 3 presentation and disclosure. Fairly well. You come to loans and advances. Just as how I spoke about investments, loans and advances given by a company are also extremely important. Now, why are they important? Because again, it's deployment of your client's money. See, a loans and advances not recovered could be the sign of a diversion of a bank amount. And if it is a diversion, it could be a 143.12 reporting issue. So today, in addition to your statutory audit normal reporting, your Companies Act also wants you to say 143.12, any frauds committed against the company by employees or officers of the company. So I don't know whether diversion comes under that parameter, but then you could have a problem there. See, again, it's a very delicate balance. I do understand, but try and discharge this to the best of your abilities. Because again, when one gets to see these insolvency cases, one sees a humongous amount of, if I may use the term, salvage that might have been possible if the audits were tighter. Again, I've been a very strong defender of our profession for just one reason. See, we audit under a framework. This is my scope. Now, today, if the inventory is not recoverable, I have to basically say that I have made a provision. Now, beyond that, and I have to do physical verification. I've done it. Beyond that, do I scrape in deep to check it out? I don't know. Another issue that I have seen in a lot of the cases that I've had the opportunity to review is a very boilerplate kind of qualifications that we do, which needs to be avoided. So I'll give you an example. If 80% of my balances are pending from related parties, and my own firm is the auditor for those related parties, can I have an audit qualification that says loans and advances are subject to confirmation? How right is it? So these are the kind of things that, suddenly pop out. And just think about it. So, you're wearing two hats, I agree, but then you can't be so much off the mark. And I find several cases like this. Now, let me come to a second issue. If 80% of the balances are pending from group companies, which have common directors, common address, common mail ID, how can you as an auditor for 4 years say that you're not able to get confirmation? Is there a problem? And in also the cases that I've reviewed, I found that these are innocuous. They're not intended. But I think time has come for us to check. Because another interesting thing I had the opportunity to do was, there are this 16,000 shell companies when I took it. I mapped out the names and addresses of these companies. It's a public domain floating information. Nobody has confirmed it. Nobody has also said, no, it's not true. I found that the share capital of these companies came to some 25,000 crores. And some sample I took, share premium is at least 10 times. So we're talking of a fairly large amount of money. I found 500 to 600 companies in just one mail ID, the registered mail ID. It said something like rocwork@gmail.com, rocwork1@gmail.com. I mean, and today if you take any company which is, slightly large, if you go to one of those MCA search websites, you don't even need to go to the public MCA website. You have enormous number of free search websites. You click into any of them, and if you click on the director, it will take you to all the other companies where he's associated. You can keep clicking and keep drilling down. You find that there are 40, 50 companies which are registered in the same address. And your client has given money to one of these 40, 50 companies. How can it not be confirmed? Somebody will look at it and it's a little embarrassing. Take care of these extra elements this year. Again, am I going to do this for 10,000, 15,000 loans and advances? No. Do it for material items. We come to share capital. oft ignored component. So last year 10 lakhs, this year also 10 lakhs. No, please don't. Please go to the MCA website of your client, download the MCA data. If your client is maintaining board minutes, AGM minutes and all that, well and good. All this should ideally be there. Because tomorrow if there is an issue in share capital, it's purely an auditor's problem. Again, one sees a lot of litigations on these share capitals, unauthorized rights issues, etc. Again, when everything is going right, there is no problem. But when something goes wrong, the first point is, who is the auditor? It's like, who's the management? Who's the banker? Who's the credit rating agency? I think there are substantial failures across all elements, but we seem to be a very soft target. And until we really sort of pull up, maybe we'll continue to be. Share capital, please download MCA data. Similarly, insist on board minutes. Insist on shareholder meeting minutes. Get it done in writing how many meetings were conducted. If there are share transfers that have happened. Ownership is a very basic thing in your company. You should not compromise on this audit procedure. Similarly, you see a huge amount of share premium. Check whether the share premium actually came in cash. A lot of times you would have taken over as the auditor of a company. 3 years, 4 years back, there would have been some other auditor. Doesn't matter. You tell him, please show me your bank statement. And that year, they would have even filed a return of allotment saying it is for cash, but no money would have come in. Please check. Which is why right at the outset, I told you the only mistake is to repeat a mistake. If this year you want to clean and sign, it's still your discovery, your pride. Doesn't matter. Last year I didn't do it. Doesn't matter at all. Please don't even worry about it. So this is very important. So share capital, just go through the whole sequence. Movements in share capital, issue of shares for consideration other than cash, share application money, rights, bonus, private placements, shares issued to non-residents, presentation and disclosure. I think I left out application money, but you can add it here. But similarly, what are the share purchase agreements your client signed? See, if it's a primary allotment, it's a different issue. But if there has been a fresh issue of capital, then there would be share purchase agreements, share subscription agreements. A lot of challenges also arise in case of instruments such as CCPS, your convertible preference shares, how they are treated. Some of the CCPS agreements look like debt. So you need to be very clear on whether it is CCPS or debt. But if it's called CCPS, I guess it's CCPS. The reserves and surplus, vanilla, whatever is stated here. Special mention, revaluation reserve. Secured loan. Now let's again go back. In secured loan, what will I have? Overall reconciliation. 2, I will have increase in loan. 3, I will have decrease in loan. 4, security offered. Whether the security is fundamentally in the name of the company itself, you need to check. Then the registration of charge for the security offered. Any unusual creation of security interest. Move from a fraud risk perspective. See, today one encounters a situation where the company is tending to insolvency. So whatever was pledged to a banker, they go and do another mortgage with somebody. Please be careful about these things. Again, not strictly within our purview, but just in terms of keeping one's eyes open. Interest on loans is a very important component. Most importantly, loan agreement. Do you have a loan agreement? With a banker, it ought to be there, but with the remaining, we don't know. So approvals for loan taken, your 186 approvals, repayment of loans, confirmation of balances, loans in foreign currency, interest payable, debentures, presentation and disclosure. I also want to add one small thought here. See, when this insolvency code came in, they created a new class of entities called as information utilities. DC, maybe you should have a session by NESL for SIRC. I'll also mail you. It could be helpful.
Sure.
So now the IBC says that every financial creditor in this country has to file the loan data, the debt data with this information utility. And in an ideal situation, that counterparty, who's your client, should go and raise a dispute. He should say, no, this loan amount is wrong, this interest amount is wrong, etc. Now, there is an opportunity for you to dip into that NESL utility to check whether the loan agreements and the loan details, the security, etc. is correct. In fact, it was rather sad that this clause did not find its way into CARO. If only CARO had said that where a loan should have been reported in a utility and it has been reported in the utility by a financial institution, bank, or a lender, is the amount reconciled or has the client confirmed such amount? If we had put this in CARO, the client compliance would have become mandatory and one whole component of the balance sheet becomes simple for you. I'll tell you where this challenge arises. The bank deems it an NPA, so they don't calculate interest after NPA date. My customer also has not calculated. I have found balance sheets where loan plus interest accumulated is 300 crores. The interest not accumulated is 300 crores. And right on top of it, there is an audit qualification that says interest cannot be quantified. My problem is, how is it even acceptable? How can you not quantify something as simple as an interest? See, maximum you can have 10 agreements. You have a principal, a tenor, a repayment. You can be broadly off the mark because of some penal clauses, etc. But from NPA date, one can calculate. So be a little careful about these things because this is a component which is easy to audit. And a lot of the money is sitting there. So, but please do remember, NESL could be an important, useful thing because it's a platform where a third party has already confirmed the amount. Your client, if he is asked to confirm, two independent parties, your client and the lender, confirming on a neutral third party portal will be extremely strong audit evidence for the purpose of that particular component. A CARO compliance, of course, there will be a separate checklist. Unsecured loan, predominantly the same, just that you don't have security. In secured loan, please go see whether your client has created that charge in that MCA website. Again, this is all open data. A lot of things are there. Another value add you can give to your client is something. I find that in a lot of cases, especially in these project execution companies, the banker is asked to give a bank guarantee. So the bank gives a bank guarantee on behalf of your client for 20 crores. Your client has finished 10 crores worth of the project. Then he should actually reduce that bank guarantee. They don't do it. Then towards the end, there is some project failure for 2 crores and the client actually invokes the entire 20 crores. I've seen companies actually go down because of this. So these are small, value-added tips that you could possibly offer to your client. Current liabilities, fairly vanilla. So another very interesting thing is two things which are very important in any audit. Three things actually. One is what I mentioned first, management override of control. That is your serious fraud risk. What your management says and somebody is obligated to do. How they actually dilute controls. The second important thing is trust and verify. You trust what is given to you, but you need to verify. The third important thing is a process that's called as full and false inclusion. So if somebody gives you a sheet of paper, you're supposed to do both ways. Typically a fixed asset verification. You have to do book to physical and physical to books. Why do you do that? For full and false inclusion of the fixed asset register. So if there is something in the fixed asset register which is not there physically, then there's a false inclusion here. Similarly, if there is something outside which is not there in the register, it's not a fully included register. That's the third important watchword. And the fourth important watchword, which is the most complicated in any audit, is something called as search for unrecorded liabilities. Everything else will be fine. Your liability will not get recorded. So when you perform a lot of your P&L tests, ensure that whatever is your periodic charge which should come, your rent, your electricity, your purchases, your numbers which have to come in every month, have to come in every month at more or less a standard amount. Your interest coming in every month. Your client might just decide not to accumulate interest at all. For the moratorium period, there is nothing that says you don't need to pay the interest. You still have to pay the interest. It's just that it's not counted for your NPA and you currently don't have to pay. That's about it. So please be a little sensitive to these 4 things. And of course, 5th is the need to stay professionally skeptical at all points in time. Very oft repeated story. Krishna goes to Yudhishthira and says, show me one bad man. Yudhishthira says, no bad man. And then Krishna goes to Duryodhana and says, show me one good man. Duryodhana says, no good man. This is described to be the greatest frailty or folly of a human, which is you always look at people how you are. We are all extremely nice. To an extent where I think I'm exceptionally proud. I can speak very confidently for the CAs from the South. I don't think we are greedy at all. So we often tend to think our clients are also like that. No, they're not like that. They don't have to be like that. The ability to stay professionally skeptical is very important. And another thing, it's a very soft kind of thing. There's another story from the Mahabharata. It's called the Yaksha Prashna. And there's something like, what is the biggest wonder? So the biggest wonder apparently is that all of us know that we will eventually not be there someday. But then we continue every day as if our life is endless. That's the problem in COVID also. Every promoter of a company will think that he'll eventually come out. When it gets into a debt cycle normally, you look at any promoter you work with, they'll say, okay, tomorrow will be a better day. It's his right to believe it. It's his confidence. It's very inspiring. That's fine. But today, if you think you have to make a provision, you don't have to buy his theory that since tomorrow will be better, an erroneous balance sheet can get corrected tomorrow. You can't correct it tomorrow. You have to stay aligned to your course. My job is to say whether it's true and fair. Please stick to that yardstick. Don't get into a problem. Provision for taxation. I'm sure all of you are much better. So I'm not going to get into this in a big way. Payroll. Payroll, very simple to audit. In fact, I'll give you a huge shortcut. However large your client is. Take 12 months payroll register. It could be 30 employees. It could be 300 employees. Put it all together. Put the month. Make a month-wise pivot table. All your students will do it effortlessly. It will give you a simple summary of opening balance in April, joined during the year, left during the year, closing number of employees. For additions, please test whether there is enough documentation. For people who have quit, see if the final settlement has happened. For all the employees, make sure pay has been charged for all 12 months in the balance sheet. If not, provision has to be made. All employees take 1 month and check with reference to their employment contracts whether the amount as per the register, payroll register, is the same as the contract. Just 1 month enough if you check. So today, what is pay? Pay is nothing but my salary as agreed multiplied by number of days worked in that month. So second part is see if there are attendance controls. 3, you will get the amount to be paid. Employer contribution PF add, deduct. Employee contribution add. Employer plus employee contribution will be payable to the authority. Net of employer contribution will be going to the bank. So it's a very simple logic. In the payroll, your deduction also will be sitting inside the employer cost. So this is a very simple method of auditing a payroll. But again, you start with a simple analytical review procedure. You say how many employees last year, how many employees this year. See, today, this year, I don't think people will book cost. It will be the other way around. People may not want to book cost because you could have a profit impact. So kindly go through these aspects. So first is internal control review, 3-way reconciliation between payroll register, payroll review, JV. Every month there'll be one JV. There'll be a pay register in Excel or Relion or whatever software that they use. I don't know any other payroll software, but I'm sure JD Edwards, this, that. Then you have a JV that gets prepared, and this JV goes into your accounting system. Sometimes it could all be integrated also, but I've seldom see people using integrated systems. Internal control review. analytical review procedures, statutory compliances, staff welfare expenses, presentation and disclosure. So these are in payroll. Electricity. Electricity is very simple. Again, a three-dimensional matrix. What are the locations? What are the months? What is the unit consumed? What is the rate? What is the total? Finished. And this schedule you don't need to prepare. The client has to prepare and give it to you. That's how you simplify this audit. See, a lot of the schedules to the balance sheet, the large firms get it done from the clients. If you can't, you can do it yourself, but you ask the client to give you data. Now, in this act, what do? Okay, you would have worked out some number, 3 crores 48 lakhs 32,000. Your client has booked 3 crores 47 lakhs 40,000. It's okay. Don't spend time reconciling. Broadly, I'm okay. Then you take 3 months and check the meter card and ensure that it is in order. Or you take 1 month also, it's more than enough. That act of 1 month is your compliance procedure. This entire schedule that you do is your substantive procedure where you're able to tally a total to what is booked in the GL. Same process for rent. All the premises, all the months, the amount of rent. It's even simpler than electricity because at least in electricity you have 2 dimensions. You have a fixed charge, you have a variable charge, this, that. Here it's even simpler. Rent. Again, this year you may have an issue on rent because your client will say, no, I'm going to pay only 50% to my landlord. A lot of this you can't challenge too much. If he's providing only for 50%, then the balance you tell him to please give a letter from the landlord if it's a material amount. Other expenses, made out something. The usual other expenses, repairs and maintenance, get subject to a GL review. Managerial remuneration. Interestingly, in 2021 Caro, they removed managerial remuneration. And you know what they brought back instead? From the 2003 Caro, internal audit has been brought back. Which means for 2021, again, I would also request ICAI to get some very clear guidance on whether there is a proposal to defer Caro 1 more year. Because although 138 mandates certain categories of companies for internal audit, Caro 2021 is saying internal audit should be there for everybody for whom Caro is covered. And I think the yardsticks of 138 and Caro are not quite the same. The yardsticks under 138 seem to be much higher, unless I'm mistaken. Auditors' fees, dividends, subcontracting charges. A lot of companies today don't manufacture in-house. You manufacture outside. These turn out to be large expenses. So typically when I'm doing an expense audit, what are my big heads? My payroll is certainly a big head. My raw material purchases are a big head. My electricity, power and fuel is a big head. My repairs and maintenance will be a big head. These are the big expenses. And this other expenses schedule is where all the others will get set. That is a schedule that needs review. There will be an inventory write-off for 20 crores. It will be there in other expenses. Please go through it carefully. Subcontracting charges could be a big head. Again, very simple. They will all be usually per unit variable rates. So how much has the contractor manufactured, kilos or units? What is the agreed rate? Again, you must have an agreement. See, sometimes you might ask me, madam, the agreement has expired. That doesn't matter. Your client still has a legal obligation to pay because the material has come in, he needs to make the payment. At best, there is something called as an ML, not an MRL. MRL is a management representation letter, the representation that management gives you saying, oh, I'm great. Everything is true and fair. ML is what an auditor issues to a client to bring out certain weaknesses and improvements in the system. You know, when I was doing my articles, the client used to say, where is my value add? So we used to give this and say, this is your value add. You'd be, at best, these are ML points. The rent agreement has expired, please renew. Subcontract agreement has expired, please renew. These don't vitiate your financial statements in their entirety. They don't. So you can at best give it in the ML, but again, what is important is in things like subcontracting, be a little careful because usually there will be some tool amortization. Your client could have given a tool. So as in, while he is charging me 1 rupee for every unit manufactured, your client will say, you have to deduct 10 paise because the tool cost is mine. So the net charge will be 1 rupee minus 10 paise, which is 90 paise. Now, how it gets treated for GST and all that, Please have a look at it. I'm not the expert. Legal expenses, a schedule that needs certain review because it is a pointer to a liability. It's a pointer to a red flag. It's a pointer to a write-off. Because somebody can file a suit against you asking you to give money, or you may have filed a suit against somebody for a receivable or a loans and advance, for which you as an auditor may need to consider impairment. Becomes important. General, all expenses should be authorized, supported. It should be for the business purpose, correct head of account, accounting period, TDS applied correctly, GST credit taken currently, and provisioned for as appropriate. So with this, I've broadly run through whatever checklists I had. And while I don't really have a checklist for Caro, I can show you something I've prepared, and I'll send this to DC. More from a futuristic perspective. This is Caro, earlier Caro and the new Caro. So what you could do is take off the new Caro in the Excel that I'm sending you.
Sripriya, the screen is not visible. If you can just redo it.
Is it now coming? No?
No, not yet. Yeah, it's fine now.
So this is a little checklist I had made on Caro 2020, but I most certainly think this merits intervention, because if they implement it for this year's financials, we'll have a problem. But I'll convert this into a checklist for you. Nothing. All I'm going to do is I'll take this off. I'll say I'll have this sent. Every aspect of Caro is here. Caro 16 is what is the applicable Caro. So you can basically convert this into a working paper template. So whether fixed assets have been physically verified by the management. So what do I write? Yes, management carried out verification on DDMMYY. What was the date? And discrepancies were found or not found. You can it's so simple. Similarly, you can do your own SA checklist, AS checklist, etc. Any of your articles, you give them a PDF, they will convert it and convert it into a checklist. So I'll also have this shared as the Caro checklist, but you need to document some procedures. So this will have other supporting papers to it. So I'll also have this sent across at the end of the presentation. But by and large, I think I am done with this importance of checklists. And if you have any specific questions, I would like to take questions on the audit process rather than on Companies Act, if you don't mind. So it would be nice to brainstorm. If you have some specific challenges or very unique client situations, I'll be happy.
You are done. Shall we take the questions, or is there anything? You are done. Okay, then I will take the one which I have prepared. So shall I take the presenter rights back and put it on the screen, the questions?
Sure.
The first question is, what is the expectation of all the regulators, especially when the company is a husband and wife company? The rules of a big company are to be followed or not?
Yeah, so that's what I had told you, right? See, if the company is a husband and wife company, you will still have to respect. See, whether the husband and wife have taken a bank loan or not is very important. That's what I told you. A public interest entity needs to be audited differently. And I would think you have to apply all the same safeguards. It's just that you can be a little less stressed and a little more relaxed. Otherwise, all other practices would be the same.
ICAI engagement letter format is only illustrative, that too only for statutory audit. What about other services?
I'll be very happy to share with you what ELs we have issued for others. Over a period, you just, these are enshrined practices. You have EL format, your engagement letter format, you can prepare for anything. See, what will be there in an engagement letter, I can describe it to you. It starts with the background. It says this client is so-and-so, so-and-so. He requires us, for example, to perform an internal audit for the end date, so-and-so, so-and-so, for the period so-and-so, so-and-so. That's your background. And when I am issuing the engagement letter, I say we are delighted to accept this engagement and we understand the context of this engagement and we have relevant experience, etc., etc. The second will be scope of work. What all will you do in an internal audit will be the scope of work, whatever is agreed. Review of MIS could be one. Internal controls. The third is it will be what are my key deliverables. You will have an interim report and a final report. What is your audit calendar? Every month we'll be performing an audit. What is the methodology? What is the fees? What is the data responsibility, that of the client? What is the confidentiality to be followed? And that's about it. So what does the EL basically say? It says the terms of the engagement. I don't think the Institute has published anything, but you find plenty of this on the public domain. Another example for EL could be fixed assets verification. So it starts with the same thing. It says background and what is the time by which it needs to be completed. So it will say the same thing, background, terms of reference to carry out fixed assets verification, book to physical, physical to book. You need to cover at least 80% by value because I can't go checking all his wires and fittings which are there. So you clearly put that there. Methodology, you say first the client will give me the Excel sheet. I will prepare my tags. Then the client has to take me. I will affix the tag and I'll reconcile the tags. That's what it does.
Director's insurance paid by the company, whether it is allowed? If so, what is the checklist for the same?
Satish, I'm not sure about this, but I think it should be allowed because it appears to be the director's D&O insurance or something. I think it's an allowable expense. What is the checklist? You have to only make sure that the insurance premium has got paid.
Correct.
So you'll have premium discharge.
In case of spin-off of companies, whether the company has filed an application for revival with NCLT, whether audit can be done or not.
I don't think you can do it. If the company is struck off, then where is the director there? Who will appoint you? You'll have a choice. Unless it is restored.
Has the time got extended for holding AGM and presentation of audited accounts? This is September 30.
Not commenting on this, I'll send it to you in writing. I'll check and come back. There has been a huge, because of this COVID, there's been a lot of change. I'm not tracking it. I'll speak to my colleague and come back.
Yeah. Next question is, original cost of few items of machineries could not be arrived beyond certain period. Original cost of few items of machineries.
I'll tell you, I think I understand where you're coming from. If you don't have a fixed asset register, how do you build one? How does your client build one? You can use my Excel sheet. What you do is, see, this is the best I can advise under the circumstances. Very ethical method of handling. Let's say your gross block total is 10 crore 2 lakhs for a particular category. You don't have a choice. You have to go back into your tally and keep pulling out. Go from the back. The last asset I purchased was 1 crore. So please add that line, 1 crore, and it will throw its own depreciation. Let it be correctly worked out. The previous asset was 30 lakhs. The previous asset was 10 lakhs. The previous, go from the back. You will fill up as much as 7 crores correctly. And let's say for that 10 crore 2 lakhs, your net is today standing at 8 crore 2 lakhs. Or let's say a little lesser, 6 crores. Now, the moment you keep going from the back, it will arrive exact values for the last 3-4 years of assets. Then you may not know the original cost. You put all the others as others and do it as the balancing figure. That's the best that your client can do under the circumstance. I'm assuming this was a question, but if your question, I can interpret it differently, is to say if you don't have original cost.
There is a addendum to that question. One second, I'll just share the screen. He says, can we take WDV of that earlier year for registering under MSME? That is the context he wants to know.
See, the MSME is the client's problem. Why would I go into it? If he wants to do a wrong declaration and declare it, let him do it. But
is it compulsory?
Gross block that you have declared in yours, you let it stay, no? Are they asking for invoice-wise detail for registering in MSME?
No, not invoice-wise details, but the information is being asked in MSME actually. That is
so whatever is the audited number, one has to stick by it, no?
No, auditor will only get the WDV. They want the original cost of the asset for that.
How can the auditor have only the WDV? See, under the Companies Act, you have to declare gross and the WDV. Only for income tax, it's the block of assets concept. And for MSME, whatever you declare will be as per the Companies Act. No? It's not what you declare under ICAI.
No, for MSME, even the criteria for that, machinery's investment, they need to give the original cost, not the WDV actually.
Which
and
I'm
many
saying
companies which
already there.
spread over so many years, they are not having that original cost.
No, do you have to give it machinery wise?
Not machinery wise, but asset wise, I think there is.
Asset wise, it's there in the balance sheet. No, you'll take the same balance sheet value.
Next, is it compulsory to report the borrowing details to NESL by the client?
No. The borrowing details have to be compulsorily reported by the financial creditor, the lenders. But it's a good practice if your client can confirm it. Because I believe there was something that came that said if it doesn't confirm, it's taken as true. I'm not sure about that.
Okay, next one. What should be the checklist for revenue? Right side of the P&L statement of service provide statement like software, etc. Service provider, I think he means.
So you're talking about revenue from operations of a software company, right? So there could be two types of software. One is sale of product, two is sale of services. Product, there would be an agreed price. Everything will be agreement driven. When is the product? What is the price? What is the date of deployment? What is the milestone? So you will put out the whole thing and as per milestone, you will record the revenue. Second could be a service. Now, even in service, there could be two types of revenues. One is time-based booking, where a client says you maintain your time sheet, whatever you're charging me, I'm doing it. Or it could be a contract milestone-based booking for finishing. So that's the basis for accounting revenue. But the fundamental thing to audit a revenue of a software company is to get a register of their revenues and then check whether all client contracts have been accounted and whether they have been appropriately accounted as per the terms and conditions of such contracts. So if I were to bottom line it, it is contract driven. That's about it.
Any specific checks regarding age-old loans from relatives, from and to relatives both?
Okay, loan from relative is actually a deposit. So you need to be a little careful.
So what if he's a shareholder as well as a relative? Any specific precautions?
See that there's a high amount of gray there.
Okay.
So directors and directors' relatives alone. If it is directors that we're talking about, see, so if it's a director's relative, then if it is a director, insofar as it is not out of borrowed funds, it's not a deposit. Director's relative also for some private limited companies, there are some exemptions. Specific checks. See, if it is a loan from, it's a slightly lesser problem for me because other than my deposit compliance, which I need to ensure, but there are several things in the Companies Act, the private limited exemptions which are providing. But loan to a director or his relative could be a challenge. Please watch out. Your 185 compliances are important. Because under 185, loan to a director or his relative is prohibited. It's
Correct.
only to an entity. If it is for business purpose, then a special resolution is allowed. Please read 185 carefully.
Next question is on provide a website to check on secured loans data. 1. Second, provide points to be considered for physical verification of stocks and fixed assets by auditor in the year end.
Okay. So secured loans, just give me some time. When we conclude all the questions, I'll take you to any website. There are so many. There's one Insta, there is a Zoba, there is a Toffler, there is innumerable Companies Act search websites. I'll walk you through one of them to tell you how I do it. Not only can you get your secured loans data, you will not get secured loans data. Okay, that is the NESL website. That's a separate thing. You can also get the security charge to the bank. I'll show you. It is there very easily available. NESL is a login process. I don't have login. Provide the points to be considered. The second part of the question, I'll take it first. Physical verification of stocks. Again, I've got a very nice checklist. I will send it to DC at the end of this presentation. It's called the A to Z of stock verification. How you have 26 points to be carried out. But I'll tell you under broad headings, first of all, a client needs to have stock taking instructions, which are issued to all the member units. 2, you need to have a clear understanding of the various types of stocks that have to be counted. 3, book records have to be there. 4, there is a method to counting. You have to go location wise and you have to go from left to right or right to left. So let's say I'm auditing a go down of, let's say, ITC. And ITC has several products. I don't count biscuit which is kept on this rack, then go to this rack and then go to that rack. I count rack wise and keep a check sheet, and then I total and see whether the biscuit total in this go down is equal to the book stocks. All excess shortage verification has to be done properly. People who are verifying the inventory have to sign the count sheet. You have to take cutoff before you start counting, which means the last invoice I have to record. After that, I should not permit any accounting entries. During cutoff, nothing should come into the go down. Nothing should go out of the go down. If one go down you're not able to cover in one day, you have to lock the go down, seal it, keep. It should be sealed so that the next morning when you come, the same team counts it. So these are some basic checks. And as you are counting the stock, you will also mark what is idle, obsolete, etc. Your client cannot come with a situation that says the entire go down contains uncountable inventory. Not permitted. Huge scope limitation. So these are the top 10 items that I told you, but I'll share this PPT and he can possibly share it with you. I can send it out. Similarly, for fixed assets, okay, one of the most common things I've seen is there will be one fixed asset register which will be printed in Excel. There will be a nice square bracket and it will say physically verified. If you read what all has gone into the square bracket, there will be one line called cement, steel, wire, tube, bulb, fitting. All that somebody would have accumulated. No, that's not how you do it. Your client has a fixed asset register, however badly maintained. Please identify the major assets and classify every record in that Excel or your fixed asset register as first verifiable, non-verifiable. If it talks about bulbs, fans, so fans are verifiable, correct? So you have to first mark that. You will get a total. Then you create one more column, considered for verification or not. Fans I will not verify. Chairs, unless they are those expensive chairs, I might not verify. So you then put considered for verification, not considered for verification. So suppose my client has a fixed asset of 50 crores. My considered for verification should be at least 35 to 40 crores, which will comprise of only verifiable assets, because a chair is verifiable but may or may not consider it. When you start your verification and go and identify each item, tag it. Fixed asset verifications are slightly vague, but this is the best way you can do it. Next.
One company where the director is directly involved in every transaction, what kind of documentation do you expect?
He should sign everything. He should sign everything, and my biggest test will be a test of genuineness. And such kind of key man risks are also high, no? So if the same director is also placing the purchase order for machinery, so let's just magnify the situation. Suppose this particular company has a 50 crore loan, and which was intended for a project. If it's only one man controlling everything, then what is the chance that 25 crores could have suffered a diversion? So that's the way you need to think as an auditor. And hello sir, from Mr. Anand.
A newly incorporated company acquired running unit in end of February. How do we report for asset verification and inventory verification, which was not carried by the management?
You just have to report in so many words. Again, let me tell you another thing. See, there are two different things. Why don't you verify it today? Why don't you do an inventory verification today and do a rollback testing? Nothing wrong, no? You can roll it back to February. See, anyway, on February, they would have declared their assets and liabilities and they would have taken it over. So you do, that's what I'm trying to tell you. One way to say is I will go in my balance sheet and just give a qualification. Instead, you can say that we verified it on this day, did a rollback testing, there were no significant discrepancies.
Can you please provide some guidelines on how to determine materiality for an audit? Subjective question.
You need to form a materiality opinion based on the values that are carried. So that's how you define a threshold. So for P&L items, so for revenue items, I will say my materiality is 20,000, 25,000. For a P&L item, I might say expense item, again, I can say 25,000. But in so far as it is not converting a profit to loss or a loss to profit, 2, there is no materiality for statutory compliances. And 3, there is no materiality for a fraudulent transaction. You need to just keep this in mind. But if Mr. Sunil wants to come back to me with a more real life illustration on my personal ID, I can advise something. I don't have that visibility.
Yeah. If the personal expenses being booked in the company, what qualification has to be made?
First, you have to reverse it. Ask the client to reverse it. If he doesn't reverse it, then it's you will have to give a qualification that says personal expenses are debited to revenue. The other thing is also the materiality. How much are you going to fight for? That's the other thing. If it's not very material, then you have to just take a call and make a request for reversal. If it's not material, even you would have reversed it. So that's the other problem. It must be a material item. So you have to say that personal expenses relating to the director are so and so, so and so. These have not been treated as loans also, and they have been expensed. If this was not there, this has resulted in the profit being understated to this extent or the loss being overstated to this extent. And subject to the above, we state that the accounts presented true and fair.
Guidance on carrying out verification of PF and ESI and reporting regarding the same.
It's actually very simple. You take the monthly payroll register. You put 6-7 columns, I think. Employer contribution, employee contribution, ESI charges, employer contribution, employee contribution, charges. Next column will be date on which remittance should have been made. The 8th column will be date on which remittance has been made. In ESI, I think you have something called EDLI also. Difference in days, rate of interest, amount that should have been remitted, amount as remitted, difference. It will answer 2 questions for you. First of all, it will answer one thorough question on whether there are any undisputed or disputed statutory dues. That amount you can fill up from here. The second thing is it will help you to understand whether there are any delays in remittance of statutory dues. And 3, whether your liability has been properly extinguished. This is how you will do it.
What if CARO is not applicable, and where does the reporting go in this case?
If it's material, then you have to qualify. If it will not be material.
Okay. Can you please elaborate on the date of AGM, date of audit report, and date of UDIL?
AGM should be held before 6 months.
Correct, 30th September.
So what is an audit report protocol? So first of all, you should never sign unless the director has signed. Please be very careful. I have seen financial statements which have been filed with the MCA with only the auditor's signature and, management not signing. Very freak. So that's the first thing. Directors have to sign. It has to. So first of all, the accounts will be adopted in the board meeting. Then, once the management says that we have adopted, the audit also gets completed, and then you have another board meeting for adoption of audit accounts. Then you place it before the AGM and it gets accepted. See, that reason why I'm asking the unaudited to be accepted by the board is because at that stage you pin responsibility and they will also sign it off. Today there are clear yardsticks, no? See, again, the New Companies Act made it smarter. They said whether you hold the AGM, whether you don't hold the AGM, you still file your return, please, and close it out. Even if it's not adopted, you can still go ahead and file.
Under CBA system of banking, few bankers deny to give confirmations. Then can bank statements be taken as confirmations?
If you really ask me a question, you should write this to this MD of those banks with a copy to ICAI. That's the solution. I mean, I can share a very personal experience. I kept on asking for a particular bank statement as an insolvency professional. They did not give it, so I just thought it fit to write to the MD. They came to me within 2 days. Please write. See, you have nothing to lose in this process. I think it's worth the while because you have a big responsibility there. Because sometimes the client also might go and tell the banker, you don't even know what's happening. Why take a risk?
Yeah, I'll just share the questions after taking the new ones.
There's one more. How to verify the stock valuation in case of a supermarket which has a lot of SKUs and what controls are there? Fairly simple, no? These are barcoded. So you just take that barcode scanner. It's the quickest thing to do. You just go check. It will give you the physical stock. And with the same barcode, you will get the product number. You can download the book stock and you do a matching. You have to adopt technology. If supermarket, I think, is simple because you have a scanner.
What would be the audit documentation for closing stock in case of processing done by job worker for the client? Job worker of the client.
So, see, this inventory is the property of the company and you have given it to the job worker, correct? So this inventory is part of your books. So you as the auditor have to ensure that that physical verification of inventory with the job worker was verified. There are two things that can happen. The material could have gone from my company, or sometimes I will tell my vendor directly to give it to the job worker. In either of the cases, the inventory is the property of the company and you need to verify the closing stock there. If it's not material, you can take a declaration from the job worker saying that it is there. But this declaration and all, please make sure it's looking a little legal. It should have a stock tabulation. It should be signed. It should be dated. It should be as on that date. And you should also compare it with the book stock. He can't just give some statement which is at variance with what is March 31.
In the agricultural processing company, what substantive procedure will you adopt to ensure fictitious cash payments are not masked as agricultural purchases, as most of the agri purchases don't have written contracts?
The payment would have gone to a farmer. No? You can still check who the payee was. So aggregate all those payments. See your top 10 payees. They would be farmer purchases. There'll be the payee needs to be somebody, no? You can still call to see the payee, no?
Correct.
That's how you do it. This is an inquiry. You actually tell them, please, can I have the phone number? Forget in everything else. You need to have a vendor master. I need to know who my vendor is, right? I need to have his name. I need to have his address. I need to have his phone number. It's a farmer. I may not have his mail ID. Ask to go and meet. Tell him, show me who this Rangaswamy is. Simple question. 5. As an auditor, you check for 20, it's more than enough.
What kind of information has to be reported in audit report if it was not possible to do a physical verification of inventory, or if auditor could not join the client at the time of physical verification? So
this is my advice to you. See, you have two options. Either you say what everybody else will say. Okay, I have not done the physical verification because of COVID. So inventory as stated by management. But you still have to perform a lot of alternate tests. Instead, see if you can verify the inventory now that the lockdown is more or less over, and do a rollback testing. See, one advantage with rollback testing is nothing has moved much in the last 3 months, unless your client was an agri company or a foods company.
Or a pharma company.
Yeah, or a pharma company. If my client had 3 crores of inventory in March, today the inventory would be 3 crore 10 lakhs or 3 crore 20 lakhs or 2 crore 80 lakhs. So the rollback is very easy if you do it today. I would strongly recommend you still see what best you can do. And you need to do a consumption rationalization for the last year.
Yeah, this question is repetition. You have taken this. Next is please provide major checklist for entity involved in purchase and sale of land like review. Sale of...
No, this is a different question. How to do stock valuation, is it? Sorry, I answered verification.
Okay.
So stock valuation is very simple, no? See, I am presuming if it's a supermarket, you would have received it from a parent, which would be a levers distributor or an ITC distributor or a Dabur distributor or a whatever. Now, each of these already come with a pre-configured price. So you sell at MRP and your margins, for every product, your margins are also pre-configured. So you have a purchase cost to it. So that's how you do stock valuation.
Please provide major
order.
Yeah, please provide major checklist for entity involved in purchase and sale of land, like to review sale of land, purchase of land, etc.
You're talking about a plot development company. What is there? Purchase of land. So I would have aggregated. I would have gone to all these small farmers and done this. So you need to have complete control on the total land bank which is held by the company, which is represented by the sale deeds of the seller, which are your purchase deeds. You need to ensure that the title is in the name of the company, the consideration was paid, and only the consideration which you have paid correctly as per bank has got accounted. You can't have cash payment and stuff like that. I'm the wrong person to advise on it. As far as I'm concerned, everything should be banking transactions and you'll have to pay. Similarly, sale of land, you're going to convert it into plots. So there'll be a plot development cost which needs to get accounted. And there'll be a sale of land. And I presume this would come under construction accounting standard. So you'll have to recognize revenues appropriate.
Section 8 company was struck off, but it is getting rental income from building in cash. Bank account is freezed and filing ITRs without auditor's report. It has applied before NCLT for restoring in ROC. Can it do so? Getting rent, ITR filing.
Can it get it? It's okay. If somebody is paying me money, why should I say I will not take it? You will obviously end up taking it. In cash, you're taking it. You're filing ITR also. If ITR is accepting, then again, ITR, why should they not accept? So the important one good news in all this is it is applied to NCLT for restoration. So let things get restored and then we will have to come back and do the audit and complete it.
Okay. The company is not generating revenue for...
Interestingly, if a company is struck off, can you do the tax audit? That also you need to examine a little carefully. See, if you're compelled to do something, if you're struck off, you anyway can't file to MCA because it's all frozen. But for income tax, you'll really need to go and meet somebody and see how to do that tax audit. Be a little careful. Because tomorrow, if there's a problem, the directors, I don't know how they'll be held responsible. Because even in those strike-off provisions, it talks about only liabilities. It says your liabilities will still stay and somebody can still come back and claim money from you. Just see the strike-off provisions in the Companies Act. We should not get caught in this client versus regulator problem. That's about it.
The company is not generating revenue since 3 years, but having positive net worth. Does it have an impact on the going concern?
No. What are the costs? How much is my cash burn? So it must be a dormant company. I must be having exactly what will happen. It will not have an impact on the going concern. So please read the standard. It talks about material change in business operations, etc. So this entire subject of dormant and shell companies. So you're typically talking of a company which has share capital, which has loans or something received from somebody, kept in investment and loans and advances. There is no revenue from operations. You just need to handle it.
How should reporting be done for trade advance becoming deemed deposit after 1 year?
How to report it? There is a section 73. Then your return of deposits filing will become that DPT form has to be filed. So you have to report it.
The certificate of commencement was not obtained within the prescribed timelines and its impact on audit report.
But you've now got it, no? So if you want, put a disclosure somewhere in the notes on accounts. It's got right. Now you got it. That must have been because of the delay in filing that registered office or something. But I mean, today, is it impacting my existence as a legal vehicle? No. Is it impacting my director's duties? No. I'll go ahead and audit and report.
Income tax demand paid relating to earlier years in the current year can be shown under current tax in P&L statement.
I'm not the expert,
Okay.
but I will not. I'll have to pass this question.
Okay. Engagement letter only through email communications, since it is not signed either physically or digitally. Is it okay?
I think it's okay. Everything today in the context of income tax, I'll come back to you. I have an answer, but it's just that since 300 people are listening, I want to be sure. So I'll come back. But interestingly, this has a CARO reference for 2021.
Okay.
It talks about undisclosed incomes, etc., on which taxes have not been paid. That has to be adjusted in the books in the current year. So
yes, somebody wants to get the presentation and the materials.
Yeah. In fact, I don't know whether you should show this as a prior period item. I'll check back and come back to you. That's more likely to be shown as a prior period item because it pertains to an earlier assessment year as a result of a mistake or an omission.
Exactly. And for the presentation, we have already shared the links, and all the participants will be getting a separate email, point number 2. Third, all the links will be shared in the SIRC website under the past programs. We have shared these links also. So all the 3 links, you can use it to get the presentation. Since COVID situation, most of the audits are made online instead of visit. What are the precautions to be taken?
See, whatever you do, genuineness is your problem. That's the only answer I can give. COVID, no COVID. Your audit evidence can be digital, but it's up to you to see. But finally, no, in all this, there is one super proof. The proof of pudding is your bank statement, which you can get from the banker. I would typically keep my audit in a COVID year very simple. I will see how much cash has come into my system after April till date. How much cash has been paid in terms of my past liabilities. With that, I'll be able to frame how much of my balance sheet and my expenses are genuine. So my supreme precaution will be test of subsequent payments and test of subsequent realizations.
Madam, you said about reversing the personal expenses. Can you please explain what will be the entries like crediting expense and debiting director's account? Then section 185 will come into picture.
So ask the director to give the cash back.
Cash back.
It should be paid back. Yeah, otherwise it's a loan to director.
Correct.
In fact, in my opinion, straight away it should be treated only as a loan to director because there is no option to debit your personal expense here.
Correct.
It's better to take a loan. It's better to take a section 195 hit rather than to take a personal expense hit.
Correct.
Because if you put personal expense in your thing, then it's going to talk about income tax here, there, everywhere. You're going to have a challenge. Instead, let this be sitting as a loan to director and a violation of 185, for which only the penalty I think is 5 lakhs to 25 lakhs. So your director can take a call.
If the tax auditor had disclosed some personal expenditure debited to P&L account in form 3CA, 3CD, but the statutory auditor doesn't deal with it, what is the stand of the statutory auditor in this case?
Only one of them can be right. But why would that happen?
No, because what happens, statutory audit is done first and tax auditor later. He may be through his audit find something.
Yeah, but
and he reports it.
One thing, if it's not a material amount and if it's not a voucher that I've checked, I have no responsibility. I don't think you should worry too much.
Correct.
If 2 people do one thing, then there are bound to be 2 opinions, if not 4. So
Shall we take some more questions?
Yeah, I'm absolutely okay.
One second, just let me download that. Give me a moment.
I'm actually very happy because we're really doing audit questions, so it's nice.
Okay. Just give me a moment. I'll share it again. Oh, I think I wronged the. Kindly provide views on audit process in regard to forward cover contracts and such other hedging instruments.
So these are, you'll have to examine the contract, the premiums that are getting paid, and you'll have to follow your accounting standard in this regard.
What are the analytical procedures to be performed?
So what are the analytical procedures performed? You perform it at an entity level and a component level. Entity level, you will see fixed assets. Entity level is your key ratios, your debt equity, your current assets ratio, your liquidity ratio, your debt service coverage ratio, your interest service coverage ratio. And component level, what all will you perform? Your fixed assets turnover ratio. See, I mean, this confusion, let's not call it entity and component. Fixed assets turnover ratio. Last year, this year, fixed assets. Last year, this year, depreciation. Last year, this year, significant change in impairment. Investments last year, this year. Income from investment as a percentage of investment last year, this year. Inventories, inventory turnover, inventory to sales ratio last year, this year. How many times is my inventory moving? Similar sales last year, this year. Sales composition, product wise change. Last year, product this composition, this year, product this composition. Customer wise composition is very interesting because when I do a customer wise analysis of sales and outstanding, I'll know which customer I have to audit. See, I can't audit everybody. Even while I'm seeking balance confirmations, sales turnover ratios are very important. Debtors turnover ratio. How soon is my sale coming back to me as cash? Similarly, creditors turnover ratio, top products, top suppliers, top customers, top purchases. See, this top perspective, it's called Pareto. It helps you to figure out what to audit. So today, if 70% of my sales is going to one customer, I will do more audit of that customer. I will move heaven and earth to get that customer confirmation. So these are the analytical procedures.
Yeah. A company has not conducted operations for last 3 years. There were some revenue expenses and so there is a loss. Will the going concern be affected?
Please read the standard on going concern.
And also Institute has given a advisory on this.
With reference to COVID, is it?
COVID, yeah.
So please
we have shared that material in the tax audit link. I will add this material to the present link also so that you can kind of go through it parallelly.
Sure.
What are the
read out.
What are the cautions to be taken for company under liquidation under NCLT? Any special AS or auditing standards? Whether carrying values to be taken as per valuation reports and creditors list provided to NCLT? Please explain.
Yeah. So see, the first thing is up to date of liquidation, you will still prepare your Schedule 3 accounts and qualify going concern. After date of liquidation, I think it is only receipts and payments account of liquidator. So that's the first thing that you need to note. That's my understanding. The second is all assets have to be taken at liquidation values in the registered valuer report. That's the way, again, I am trying to approach it because that is what it is. This is the list of assets and this is the carrying costs. So obviously you'll have to downscale it. Now, liabilities, I will not restrict it to claims. I'll tell you why. the claim can be filed up to any time. See that there is no time limit. Although the IBC says that the claims have to be filed within 30 days of liquidation commencement date or something, NCLT has the power to condone a delayed claim. So what is there as a liability in my balance sheet, I will not extinguish. However, you may give a note saying that the liability is 30 crores 82 lakhs, total claims received. You can give a nice reconciliation. Claims both in books and admitted for the same value. In book higher, admitted lower for so many parties. In books lower, as admitted is higher. And not at all in books, but the claim has been admitted. So all of these are possible in a liquidation situation. Was I too fast?
No. Absolutely.
Just a claim, simple. As an additional disclosure, you can give the reconciliation.
Okay. In the two companies, the same persons and their family members are shareholders and directors with different shareholdings. Each company has given guarantee for the bank loans of the other company. Can they do so?
So this will attract 185. But the only thing is, they have given a loan or a guarantee to a company in which a director is interested. Okay, and so as long as it is used for the business purpose and special resolution, it may not be a challenge. I reckon that there will be two different bankers. It is actually the banker's problem. Banker has a problem here.
Correct.
Comes as a counter guarantee. So I don't know whether the second guarantee was given in pursuance of the first guarantee.
If a company has borrowings from directors and profit and loss account debit balance and no other assets or liabilities, what is the audit action required?
It has borrowings from directors. That means it has a loan from a director. No asset. There is only share capital, loan from director, negative reserves and surplus. What is the audit action? You only have to ensure that the loan from director should not be borrowed fund, otherwise it becomes a deposit. And that's about it. Why would they keep a company like this? You may as well liquidate it, no?
In continuation of my question, I am the auditor for their other group companies which are also under CARP, and they had a lot of intercompany investments and transactions.
What is this earlier question? Liquidation.
This was the one, yeah.
Okay, so it's not so much your responsibility as it is the responsibility of the auditor and of the resolution professional and the liquidator. If there are lots of intercompany investments and transactions, then the RP, the insolvency professional, is required to do something called as an avoidance review. If value has been lost fraudulently or wrongly by the company, they call this as PUF review, preference, undervalued, fraudulent or extortionate transaction. If the company which is undergoing CIRP or liquidation has a problem with any of these transactions, okay, which could include a fraudulent diversion to an interrelated party, then it is up to the insolvency professional. It's a mandate on the insolvency professional to go and report it to NCLT and get directions. As a statutory auditor, I'm not seeing a responsibility what you should do here. Other than the fact that your accounts for which you are the statutory auditor, one needs to ensure that the true and fair opinion is maintained.
Past IT liabilities paid in the year has to be accounted in P&L if they are crystallized in the year. I think that's the addition.
Yes.
Audit checklist for a private limited company accepting foreign direct investments.
I'll tell you what is the audit. I can't make a checklist now, but if you're accepting an FDI, it's either a loan or it's a equity. So let's talk about equity first. You will have to go through the entire process of receiving the equity, right? There has to be either a fresh issue or which will have to be originally offered to the director. So normally this is how they do it. So they offer it to the existing shareholders who will relinquish, and then there will be another person who comes in. Even in that FDI today, there is some China, non-China problem that you have to check out. I'm not too sure. You'll have to ensure FEMA compliances. You'll have to see that the money has come into the bank. There has to be a share purchase agreement, a share subscription agreement. compliance of conditions, receipt of money, allotment of shares, all within the respective period. Then that bank has to give you that FIRC very importantly. You have to close that FCGPR filing. So that is, and similarly with if it's a borrowing, you'll need to treat it as such. I see in this it's more a corporate secretarial kind of checklist that you're talking about rather than a financial audit checklist.
For MSME disclosure requirements, details not given by the company, can the auditor give a note for the same? Will safeguard statutory auditor?
Details not given by the company. The company will say that nobody told me they are an MSME.
Exactly.
The company will say in its balance sheet, to the best of our knowledge and information, we sent a letter to all our vendors. They never said they are MSMEs.
Yeah, I'm just giving back the rights to you so that you can show that on the screen. This one question had come on these loans.
One.
Yeah, I'm just sharing the rights to you.
You see, for some strange reason, I'm not able to get my Chrome
working.
Yeah, 1 minute.
Or if you can tell me the site name, I will put it under my thing.
Just put anything. No, just call any company. Let's say, just give me the name of some company. Anything.
Yeah, I'll just share my screen first.
Yeah, just put, let's say, Infosys.
1 second. I'll just share my screen just a moment.
Let's take some company which we, okay.
Is my screen visible? Yeah. What do you want me to try?
Just put info, let's say Tata Steel, Zauba. Zauba is one search engine.
Tata Steel.
Yeah. STEEL.
Okay.
You should put Zauba after that.
ZUBA.
ZAUBA.
ZU?
ZAUBA.
ZAUBA. I'll click this.
So let's assume this is the client I'm auditing. Open it.
Yeah.
They extract MCA data. These are all vendors. I'll show you two more also. So this will give the name of the company, the information. See here in the come down. So it will give here the corporate identification number of your client. Just go up. Go up. Go up. And here it will say company status of Tata Steel is active. If your client is a strike off company, it will say it is struck off. Then you come down. It basically describes the company. Scroll down. Scroll down. Scroll down. It will give all the names of the directors.
Yeah, directors' names are here.
If you click on view other directorships, it will tell all the connected enterprises.
It has come, all this.
For example, if you click on Tata Steel Foundation, it will tell you whether Tata Steel Foundation has filed its returns on time. If you go up, it will say the last balance sheet date is so-and-so, so-and-so. Go up.
It says active.
No, go up in the verbal description section. Just can you maximize your screen?
It is in maximum mode.
Okay, then come down slightly.
Okay.
I want to see the text lines. Yeah, stop there.
Here it is.
So here it says Tata Steel Foundation's AGM was last held in 19. Balance sheet was last filed for the period to 31st March 2019. So you take each of your directors, you go to the company that you're auditing, go click on the director, go to each of the companies that the director is a director in, note down this date alone. If this date is 2016 in any of his companies, then he is anyway disqualified under 164(2). You have to be careful. However, our director very happily would have even given you a certificate saying I'm not qualified. Please be a little careful, and in a lot of some cases, you may not even insist on a certificate. Please do. See, because the problem is these are fundamental legalities that you need to be careful about. That's about it.
Sripriya, thank you so much. In fact, we were able to take 1 hour of question and answers actually,
And I'm
almost.
very, very happy. So thank you very, very much. And if somebody is in
Yeah,
Chennai,
in fact, I still remember when we had a discussion whether we should make it a 2-hour session or 3-hour session. I told you a lot of questions come and we should give a sufficient time so that people are able to kind of get that clarified. Because for a 2-hour session, it would have been difficult to cover all the questions what we have covered actually.
it was absolute pleasure, and I'm eternally indebted for all this learning to SIRC and to the council. If any of you is going to be in Chennai, please do drop by for a coffee after these COVID times. So,
Yeah.
thanks. Thank you so much.
Thank you so much, all of you.
Great
Thank you,
job,
Sripriya, madam.
I think it's been a very difficult year for a chairman. So, and I think you're doing very, very well. So, all the best.
To be honest, I'm actually enjoying it. With technology coming as an aid, I'm enjoying the things actually.
Very nice. Yeah, very nice. All the very best. Thank you very much to
Thank you all of you. Thank you, VS, and thank you, ma'am. Take care. We'll join for the next session. Thank you.